The incentive to hop into European equities, and as well, if it has repercussions into the Japanese yen, into cable, is that a tailwind for the equity story?
We're watching a number of individual names. Joe Easton was talking us through some of them. Givaudan is one of those, of course. Darktrace also in focus, raising their margin forecast. I mentioned this because it was under pressure as a result of a KKR offering recently. So we'll keep that one in focus. In terms of the big picture, though, we're post-CPI. We're pre the ECB, as Guy was saying at the top of the last hour. And we have European equity markets just opening up. The FTSE is fairly flat out of the gates. The futures picture suggested we might get some outperformance. The GMM screen didn't show commodities screaming higher, so we'll see whether we get any of that. Iron ore prices are up by 1.1%, but the FTSE sort of in with the pack so far. The DAX pretty flat as well. Stock 600 then just down a touch, waiting for the ECB later.
Givaudan's up, SocGen's up. Two stocks that Joe was mentioning a little bit earlier on. I'm just looking at some of the downside. DT looks like it's a little soft. Just want to check my list and see whether Deutsche Telekom is ex-dividend. So we're just going to see that complicating factor coming into the market this morning. ASML looks a little soft as well, but there are a bunch of ex-Ds. Is Lloyd's on the list as well? Might well be. Yeah, Lloyd's is down as well. So the kind of the big losers this morning are all trading ex-dividend by the looks of things.
Lloyd's, HSBC, Barclays, there is a banking theme here as well. I'm curious how much of that is a rate story.
Well, Lloyd's is ex-dividend.
Ex-dividend. But then you've got the others, the HSBC, the Barclays as well. And then you mentioned SocGen already. UBS is trading lower when you look at some of the European indices as well. So it's not just UK banks. It's
what do you do with the banks now? And you look at the rate story, and what's going to happen with the net interest margin story as we look at what potentially could happen with the rate story in the States? Is this something that JP Morgan's going to be talking about? Is it something that is going to have a material impact? If we're not going to see these rate cuts coming through, and we're not maybe kind of pick through sort of peak NIM, I don't know. But that's been one of the things that has had a big impact on the numbers recently.
Yeah, there was a fear that net interest margin positivity rolls over as rates get cut, and if we don't see that happening quite so soon, and importantly, if it's not enough to trigger distress amongst corporates and those they lend to, but that's a question we'll maybe pick up later in the programme, because we've got some interesting reporting around German corporates on that front.
But this is where I think the earnings season story, when we start talking to some of the banks again, is really interesting, because in the last, I want to say, quarter, we had spoken to the BNP Paribas CFO, and we talked about this kind of outperformance in their Italian business, which was really driven by that margin story. If you see kind of this peak margin conversation continue, or an expectation that cuts are fueling this kind of euro weakness story, what does that do to these record profits for a lot of these European banks that are, by the way, investing in my favorite buybacks and dividends?
So interesting, if you go to the GRR and you look at what has performed so far this year in terms of the performance that we've seen out of the stock 600 year to date, autos have done very well. There's a story out this morning talking about the fact that actually it's going to be German industrials, and we mentioned BMW, we mentioned Mercedes in that story is where the struggle's going to come this earnings season. The banks is the next best performing sector. What happens with the rate story there, and how does that work its way through? Now, I know there's a sort of excess cash from a big return to shareholders story there too, but I think that there's a few wrinkles beginning to appear in some of those stories.
Yes, absolutely. I was picking up on that strength in the auto sector with Craig Trudell just yesterday, the auto czar here at Bloomberg, and he was reminding me, to Critty's point, about the buybacks in that sector. So even though there's been this sort of slightly negative narrative around EVs, they've been countering that, in the short term at least, with buybacks. How long can that last?
Well, I mean, it all comes down to how do you re-strategize based on the macro? How do you re-strategize based on the inflationary story? And how persistent is it really? That's going to have ripple effects on the currencies, on the stock story. So let's get back to that core conversation. We had heard from both Larry Summers and President Biden about what the path may look like for the Federal Reserve. Two views, Two very different takes. Take a listen.
You have to take seriously the possibility that the next rate move will be upwards rather than downwards, and anything could happen. Markets could crash, the indicators could turn down, but on current facts, a rate cut in June, it seems to me, would be a dangerous and egregious error.
I do stand by my prediction that before the year is out to be a rate cut. This may delay it a month or so. I'm not sure of that. We don't know what the Fed is going to do for certain. But look, we have dramatically reduced inflation from 9% down to close to 3%. We're in a situation where we're better situated than we were when we took office.
Joining us now for a little bit of the market read through there, Alberto Gallo, CIO and co-founder of Andromeda Capital Management. Good morning.
Good morning.
Thank you for joining us.
Thank you.
One of the kind of repercussions of the story is this massive move you saw in yields, 20 basis points overnight. A question of now that we've crossed 4.5%, is 5% on the horizon? And is that as much of a scare factor as the last time yields were at 5%? How are you thinking about it?
So it's on the table, 5%. I mean, yields are now around fair value, but we know the U.S. economy is reaccelerating, both growth and inflation. You know, we're growing at a very fast clip. The deficit is still pro-cyclical. You know, the U.S. government is spending, even if unemployment is at record lows. And, you know, these rate cuts that the Fed has talked about have reignited financial conditions. Financial conditions are extremely loose. They're not tight. Credit spreads, stock multiples. So the economy has been red hot since the pivot in October. The Fed does not need to cut. If they do, they will reflate the economy and the long end of the curve. So the 10-year might continue to go higher from 4.5 to 5. Whether this will scare markets, it will depend on the speed. So far, central bankers have been very able to massage the market to contain the speed of the move. But it's become very clear that it's hard to keep a 2-3 rate cut narrative in this market where every economic indicator is pointing to growth and reflation. And, you know, some of the inflation numbers in the CPI report are very sticky. They're monopolies like healthcare or, you know, auto insurance. So it's going to be very hard to bring them back down.
Is there a concern in this bond market about excess supply at a time when so many people were expecting this kind of bull run in terms of bonds? In just the last 24 hours, yes, we got that CPI report. We also got a very poor Treasury auction. We got FOMC minutes that suggested perhaps a change in pace around tapering. How are you thinking about excess supply in this market?
There is supply. There's supply from governments. Remember last year, just a few months ago, everyone was worried about the auctions. Then after the Fed pivot, we all became, you know, very comfortable with duration. A lot of large asset managers recommended to buy duration since the beginning of this year. We don't like duration. We don't like government debt. Government deficits continue to be really high. And even in the credit market, investment-grade corporates, you know, their average maturity has gone up to 13 years if you look at the U.S. investment-grade index. So it's gone up from being below 10 to 13 years. It's a duration game. Spreads are really low. You don't really get paid here to buy treasuries or investment-grade corporates.
Is there a difference across the Atlantic? Do I avoid treasuries and buy bunds, buy gilts?
So look, that's a great question because the differential between treasuries and Eurozone duration is at record highs.
Yep.
And there is a consensus that Europe is in a quagmire and that, you know, while the U.S. is exceptional, you know, Europe is facing recession fears and a really bad growth situation. But China is stimulating. With a potential Trump victory, European governments are getting together. Euro Parliament elections are key. We'll need to understand how the appointments post-elections will be distributed. And there is a stronger consensus to spend on defense across European governments for the first time. And you've got manufacturing PMIs going up. So the idea that Germany is in a recession while the U.S., you know, inflation is going to be at 3% probably by year end. You know, this differential in growth and inflation conditions might close because European governments are realizing they need to spend and they're behind the curve on spending. And, you know, remember, Europe still has Mario Draghi, and something might happen there on defense and a fiscal
union. Waiting for his reports on how Europe gets its act together and figures out how to become more efficient. I think it's going to be really interesting reading when it finally comes out. Is it going to be a kind of bumblebee speech moment? I don't know. How worried are you about CRE? Every time I see rates, this rate story, continuing to move in the wrong direction from a CRE point of view. I'm becoming more and more kind of aware of the fact that maybe the shoe hasn't dropped yet, and this whole idea that this is manageable becomes a little bit more difficult to kind of work your way through. If CRA, how worried are you about it? And if it cracks, where do I look?
So, look, this has been a very slow-moving credit crunch. Last year, everything got lifted by the Fed pivot. But after 15 years of QE and low rates, there's a lot of capital structures, both in the US and Europe, that are unsustainable. So companies that were funding at 2% or lower in real estate, but even other sectors. So far, in just 3 months this year, we had a number of companies in Europe that went into stress, like from Intrum, a debt collector, Altice, a telecom company, Atos, French telecom, Grifols, and Ardagh, a glass maker. So these are all different sectors, different companies with relatively low yield capital structures for 10 years. Today, they find higher funding costs and higher operating costs, and they say, at some point, I cannot make it with the current amount of debt. So it's been a slow motion credit crunch. Default rates and restructurings are going to go up. So far, slowly. The ECB is still accommodative, so the pace of the rates increase it's not going to shock markets, especially in Europe, but rates are going to stay high, and at some point, you're going to have to understand, which companies are the good, which are the bad, which are the ugly, and can still make it. And that's a very interesting point.
And we have a story on this very theme today around Germany saying corporate distress measures are at their highest in some 4 years. So square that with the fact that you said you don't get paid to own investment-grade corporates out of the US, but you like European credit. Help us be careful about what you mean there, Alberto.
Well, look, you want to go where there is fear, where there is risk premium, right? And today, the easiest sector to go into has been, especially after the Fed pivot, has been duration, and it's been US investment grade, which essentially is a duration play. But high quality credit is at record lows in spreads and record high on long positioning. So if you think about the high yield space, that's where still there is some risk premium if you look in the right parts of the market. And there are some parts of the market that are going into stress, and that's where opportunities arise. But you have to be able to distinguish, the good from the bad firms. So the ones that can survive by selling assets and restructuring, and the ones that are unsustainable. So that's where there is an opportunity for name selection. But yes, overall, spreads are much tighter than they were last year.
Thinking about where the European economy goes, we had a headline earlier on saying that China plans to strongly spur investment and consumption, this coming from the National Development and Reform Commission, and that clearly plays to one of the things you've been thinking about already, because you mentioned how China is stimulating. I mean, not enough for some people's view. We saw Janet Yellen earlier this week in China, last week, talking about how they need to do more to get the Chinese consumer spending. What kind of positive impulse could we see for Europe if China is doing something material?
So China is still unable to go back to the 5%, 6%, 7% growth years. It's uninvestable still. But the idea that they are doing something, and perhaps they are panicking, they're finally doing much more than they wanted to do, shows that the worst case scenario of an implosion scenario, that's off the table. So China doing more than they were doing means that you don't have that recession scenario anymore for Europe on the table. It's off the table.
Alberto, great to see you. Thanks for stopping by. Really appreciate it. There's so much to cover. Alberto Gallo, CIO and co-founder of Andromeda Capital Management. Thank you very much indeed. Quick look at the core six, figure out what is happening here in terms of the picture around Europe. Stocks, there you go, nicely divided today. That feels like a market that is kind of struggling to move in a clear direction. Some of the big names moving in different directions, cancelling each other out. Let's get some individual stock stories. Joe Easton, over to you.
So the chemical stocks are among the best performers on the Stock 600 at the moment, given that earnings update from Givaudan. Now, there was a clear story there in that the personal care, skincare products, potentially the strength, but food and well-being is actually weakening. So they are seeing potentially people trading down at companies like Nestle, Unilever, but the luxury end of their client base, LVMH, potentially one of their strong points. We're seeing rivals all gaining, so Simrise over in Germany and a couple of other Swiss firms as well, DSM and Clariant, rising rising at the moment in early trading. Some decent gains in those stocks today. Then we'll look at a couple of other earnings stories. We've got a report out from Publicis, the big French advertising company. They've had some weak reports giving concern around a slowdown in advertising by tech firms. The report not actually that bad today, pretty much reiterating guidance, though relatively cautious on the outlook. The share's pretty much unchanged, 0.2%. And then a couple of earnings upgrades to bring you over in the tech space. It is one of the largest makers of endoscopies. So we're over in medical tech. We're covering all bases today. Ambu in Denmark gaining 7%. Really strong earnings from them out of Copenhagen this morning. And Darktrace, you mentioned this one. It is the cybersecurity company, one of the many firms in the UK that's had a bad run since its IPO, but better than expected margins out of them today. And that stock is up 8%, so really outperforming on the UK market today. Then in terms of SocGen, we had news of that asset sale. It is around 1.1 billion euros worth of cash they will get for their equipment financing business, and that stock getting a decent boost today, up 3.7%. Potentially that might feed into the buyback story. That's something that analysts wanted to see more of, so that is supportive in terms of their capital base at the moment. And we mentioned Marks and Spencer's, all those menswear and kidswear clothing. That's what JP Morgan likes, and they do upgrade the stock to overweight. The first time since 2015 that they've recommended buying shares of Marks and Spencer as they make ground in the clothing space. That stock trading above pre-pandemic levels. JP Morgan says it's worth 330 pence a share. It's only trading at 261, so we can see potentially some decent upside for that one. And finally, over in autos, we've got Volvo. Now, this is the truck and bus business of Volvo, not the car unit. This one getting a downgrade at Citi. Citi warning that customers are unlikely to be willing to upgrade their orders and replenish their orders given the economic outlook at the moment. It's been a really strong outperformer, but Citi say the gains have now gone too far. Struggled to see upside, as we have on the screen here, and the stock is down 2.9% for Volvo over in Stockholm.
Joe, thanks very much indeed. As Joe's been talking, we've been monitoring what's happening with the bond market. Yields are higher across Europe going into the ECB press conference a little bit later on. Christine Lagarde probably wants to pay attention to this next piece of news. Lufthansa and its cabin crew union agreeing a pay deal. There's been a series of strikes recently which have really hit the airline quite hard. That union deal, 16.5. Let me just reiterate that. Pay increase plus a €3,000 bonus that will be going to cabin crew. Kind of speaks to this wage narrative that we're kind of wondering what impact it's going to have in terms of the thinking at the ECB. Is the ECB also going to be thinking about what's happening in Germany and that German economy and how it is performing? Very much tagged as the sick man of Europe at the moment. Is that going to show up in earnings season? We'll be talking about that next. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time. Hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
This is Markets Today. We're about 20 minutes into the European trade. A little bit of a mixed session. It feels like Europeans are just waiting for what's going to happen with the ECB. What kind of signals do we get from Christine Lagarde? But plenty of individual movers that we've kept our eye on. Before the break, I was talking about Lufthansa as well. Is just one stock that we are keeping an eye on, specifically in Germany. Others, German industrials, may proving to be the biggest drag on European first quarter earnings. According to Bloomberg Intelligence, 7 of the country's Eurostoxx 50 companies expected to drive, get this, a 7% drop in EPS for the entire index. Bloomberg's Oliver Crook digging into the numbers and joins us this morning. Ollie, walk us through what you've discovered.
Yeah, so we're looking at that EPS and what we're expecting in the first quarter, as you say, overall a 7% drop. But that's really going to be driven by 7 companies, I guess whatever the opposite is of the Magnificent Seven, 5 of which are going to be Germany. And many of those you will recognize as the industrial names. So Bayer, Mercedes, BASF, BMW, and also the biggest one, which is Infineon, which is actually obviously a tech company, and you say maybe it doesn't belong there. But actually, Infineon is the biggest provider of chips to the industrial sector, to the auto sector, and they're expecting EPS there to drop by about 45%, which takes us nicely over to Mercedes and BMW. We're expecting drops of about 28% and 17% respectively. And it's interesting because we did also get sort of a premonition of what we're going to get in the first quarter because we got sales from the big 3 automakers here in Germany just this week from Volkswagen, Mercedes, and BMW. And what we saw there, particularly looking at EVs, was actually a drop in EV sales, which is not really a very good sign given that this is supposed to be the growth driver going forward. Volkswagen EV sales fell by 3%. The same at Mercedes was down 8%. BMW was the outlier. They grew by 28%, so you need to give them credit there. But really, all of this sort of culminating sort of in a large omen for the German earnings season, which is about to kick off here just about next week.
Okay, so that's a number of German corporates and a couple of others to keep in focus then in terms of that earnings story. Ollie, what about the overall sense of stress for German corporates right now? We were talking to Alberto Gallo a little bit earlier on about this, and we've got some interesting reporting that suggests corporate distress measures at their highest in 4 years.
Yeah, so what they're looking at is this law firm called Weil that looks at about 4,000 companies across Europe to look at kind of their levels of stress. So this isn't distress in the sort of technical term in terms of credit, but looking at sort of what are the different factors coming in and how much stress these companies are feeling. And what's interesting is going into this quarter, what they are seeing is the stress coming principally from profitability. So what they see is there are still elevated costs. You still have elevated inflation. You have the high rate story. A lot of that has already been passed on to the consumers. And so now companies are being forced potentially to cut prices, really putting the squeeze on margins. And when you look at where it is most concentrated, they said the most distress of all the countries in the Eurozone right now is Germany. It is at a 4-year high, the highest since the level of the pandemic. In terms of sectors, you may not be surprised to hear that it's, real estate, followed by some of the cyclicals and industrial names. But something else that I thought was interesting that bears, I think mentioning ahead of the ECB decision today and ahead of earnings was the ECB bank lending survey. We had this just a couple of days ago, and they were looking at credit demand in terms of companies who were taking out loans. That fell by 28%, almost 30%, which isn't the lowest print we've had over the last couple of quarters, but it's significant because it is obviously a large drop. It is moving in the opposite direction, and the expectation was that for that to stabilize last quarter, to come in at 0%. So loan demand just not there coming from companies.
Great stuff, Ollie. Thank you very much indeed. Ollie Crook joining us out of Berlin. It's going to be interesting to hear what Christine Lagarde says maybe about the German economy a little bit later. Let's focus now on what's happening in the UK economy. UK property surveyors, the most optimistic they've been about new buyer demand in more than a year. So this is the kind of the third consecutive month, the third month that we've seen actually decent numbers, and the momentum maybe starting to build here. But remember, it's been a very cautious market. Sam Unstead joins us now from our Markets Today blog. Is this the arrival of spring, or is this the arrival of a better market?
I think it's much more the arrival of spring, actually. I think there is. The spring selling season is coming up. You always see a little bit of an uptick in house sales then. As you kind of just mentioned, Guy, in this RICS survey, yes, things have been improving. Optimism is going a little bit higher, but it is coming from quite a low base. And transaction activity in the market is still quite low. You know, house prices have sort of stagnated, but actually underneath the surface, actual transactions taking place is still not that much higher.
Let's talk about the Bank of England then, Sam. We've seen, of course, the US CPI, a number that surprised on the upside. And, you know, that's a different economy, but it still raises questions for what happens here in the UK and how quickly we get to cuts in that context. We have Megan Green speaking. I think she's going to speak a host of times over the next couple of days, isn't she? And she's already been writing op-eds saying, you know, cuts are still a long way off.
Yeah, cuts are still a long way off. And very specifically in that article in the FT today, that comparing the UK and the US is not necessarily the best thing to do, particularly for markets when they're making bets on when rate cuts are going to come. And, you know, as we're talking particularly about the housing market, that boost in transaction activity isn't really going to come until rates do start to go down, or it's at least expectations firm up that rates are going to go down and a bit more competition comes back into the mortgage market, where the cuts to mortgage rates or the lower mortgage rates have basically stalled where they are for now.
What does affordability actually look like? We did a big segment on Tesco and kind of food inflation, and even that kind of the numbers, there's a little bit of volatility there in a historically fairly kind of sanguine market. What does affordability look like for housing?
Not great in the UK.
Sure, but is it getting better, I mean, or is it like, what are we waiting for that tipping point?
I think it's getting marginally better, right? So the tipping point really is going to be the Bank of England cutting rates again and mortgage rates starting to come down. But I think you have to remember that mortgage rates have gone up very significantly over the last couple of years. Yes, wage growth is outpacing at the moment, and that is going to help things a little bit, but only a little bit, you know. And as soon as the housing market does come back into health again, you're likely to see prices go a bit further, and that affordability is going to fall away again. So if it does improve, it will really only improve by a small amount.
I talk about a big spring. I think that's a very loose term at the moment in terms of kind of the description. It feels like the country's largely underwater. So if it just stops raining, I think that'll probably get people out and about. Sam, great stuff. Sam Unstead joining us from our Markets Today blog. Thank you. You can get more from Sam and the rest of the team on the front page of the Bloomberg UK website, or simply by typing TLIVGO into your Bloomberg terminal. What are we going to talk about next? Another factor that is kind of introducing itself into this inflation story. Oil climbing, traders watching for a potential attack on Israel by Iran, or potentially one of its proxies. We will talk about that story next. A little bit of a tick higher in crude this morning. We're back north of 90 on Brent. 90.65 is currently where we are trading. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, you know, Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Since the Houthis started shooting at ships in the Red Sea, we've had a lot of disruptions, but importantly, we've had longer trade routes. Ships are on average 10% faster than they were pre-war, so that takes a lot more fuel. So a lot of the world commerce is really kind of picking up. And then we have, of course, an important uplift in cyclical conditions, right? It's one of the reasons why everyone's wondering if the Fed is really going to cut rates or not in June.
Francisco Blanche, head of global commodities at Bank of America Global Research, exploring some of the themes around commodities right now. This is topical because oil has been climbing for a second session as traders watched for a potential attack on Israel by Iran or its proxies. Bloomberg has learned that the US and its allies believe major strikes of that nature could happen within days, risking a significant escalation of hostilities in the Middle East. Joining us now, Will Kennedy, Bloomberg's senior executive editor for energy and commodities. Will, so there does seem to be some expectation in intelligence communities that something of that nature could happen. In terms of what this does to economic expectations and the markets, we focus on oil for reaction there because disruption so far, as we were hearing there from Francisco, yes, there's been disruption in the Red Sea. We've documented that a lot, but it's just made the oil take a longer route round rather than actually bringing into question the volumes.
No, that's right. And of course, the war in Israel, in Gaza, has not disrupted any oil production, and it's not clear that an Iranian strike on Israel would do that either. The concern here for oil markets, and the reason that there is clearly some geopolitical risk premium in the price at the moment, is that any action leads to an escalation of tensions or hostilities between Iran and Israel, which ultimately would have an impact on exports from Iran and the rest of the Gulf region through the Gulf of Hormuz. That's always the big danger for the oil market. I think most people would say it remains a remote possibility, and there would be many stages we would have to go to get there, but clearly it is a risk that the market's aware of and is starting to price in.
This risk that we're talking about, how does it get priced in when the geopolitical premium, at least the spread between, say, Brent and WTI, is narrowing? What does that look like?
Well, I think that spread is narrowing for perhaps different reasons. I don't think that there's that there's a geopolitical aspect to that one. I think what we can say, as we look around oil globally, it is tight, that the market is much tighter than people were expecting at the beginning of the year. And so you've got a geopolitical situation on top of a market which is fundamentally tight in that demand is strong, perhaps stronger than people expected on the back of the strong economic data that we're seeing, and supply is constrained principally by OPEC, but also other events in the world, like this announcement we saw from Mexico last week that it's going to export less oil, perhaps events in Russia with Ukraine striking refineries there. So there's this underlying tightness to the market, and you put a geopolitical layer on top.
Joe Biden is clearly worried about inflation still. He was kind of yesterday hedging his bets on whether or not, kind of when the Fed's going to be cutting rates, because we saw inflation tick higher. Gasoline's getting up to 4. Driving season's coming. Is there anything that Biden can do about it?
It's tough for him. I mean, I think one thing you saw the defense secretary clearly say this week that it wasn't helpful for Ukraine to attack Russia's oil system directly. But beyond that, it's difficult because the market is tight. I mean, at the start of the war, he obviously turned to the SPR and released huge amounts of oil onto the market, which did take some of the sting out of the market. There's less oil in the SPR now, so that will make him reluctant to do it. And it's a controversial thing to do because the reserve is there not to get the president out of a hole, but to react to big geopolitical disruptions. So could he do it if in an extreme situation? Possibly. We don't know. But there aren't that many levers that he can pull. But I agree it could become a big political problem for him.
He's taken trips to the Middle East in these situations in the past, hasn't he? So, I mean, what's the latest thinking on where OPEC Plus wants to see?
I mean, that's the absolutely vital question, Anna. I think that talk to anyone in oil right now, and they're placing an enormous amount of emphasis on the OPEC meeting in June. They've held the line through the first 6 months of the year. Clearly, we heard the head of Citadel Securities this week say that OPEC has really regained control of the market. So the principal player today is going to be the Saudi oil minister, Prince Abdulaziz bin Salman, and his colleagues in OPEC, and what they do next. So I think more and more attention there. There will be some tensions within the group, perhaps. You know, the UAE is perhaps more keen to put oil into the market, but all eyes on that meeting in Vienna.
All right, Bloomberg's Will Kennedy telling us about how the Saudis are back in the driver's seat. We thank you so much for that story. I want to stick with the geopolitical situations around the world and focus in on Asia. The U.S. and Japan have unveiled plans to deepen their security ties. It comes as President Joe Biden hosted Japanese Prime Minister Fumio Kishida for an official visit aimed at countering China. Now joining us now, Bloomberg's Tokyo Bureau Chief Isabel Reynolds joins the program. Isabel, this is interesting given some of the South China Sea tensions are only getting more and more exacerbated. A historic further military alliance. Walk us through the outcome of the summit and how significant it really is.
Right. Well, President Joe Biden sort of really played this up as the biggest sort of strengthening of ties between Japan and the U.S. since their alliance began decades ago. What it consists of is things like increasing their interoperability. That sounds quite technical, but their ability to work together. There are more than 50,000 U.S. military personnel in Japan, and having them sort of be able to work together with their Japanese colleagues more closely. Also things like joint defense procurement. They're going to set up a council to look into how they can work together more closely on that, and that could be things like missile development and production. It could be things like Japanese workers repairing U.S. naval ships, for example, as some of the future projects. But they also talked about broader cooperation in a whole range of areas, from AI to outer space. They're talking about a new NASA project to go to the moon and the first non-American astronaut to land on the moon.
What should we expect? So that's the defense side of things. What are we expecting for the rest of the trip?
Right. Well, one of the things they talked about was creating this kind of lattice of security relationships across the region. And the next step in this visit is part of that process. They're going to have this trilateral summit with Ferdinand Marcos of the Philippines, and try and bolster that kind of trilateral relationship in terms of Coast Guard patrols, in terms of having their naval forces work together. So that will be an interesting outcome to see tomorrow. But one thing that Kishida does want to focus on is emphasizing how beneficial Japanese investment is for the U.S. So he'll be traveling to a Toyota factory to show, this is how Japan invests in the U.S., provides jobs, and it's not a harmful thing. This comes amid controversy over the Nippon Steel proposed takeover of U.S. Steel.
Yes, I'm going to ask you exactly that, Isabel. So there's plenty of good vibes in the room, clearly, between these two. President Biden playing up the positive side of this cooperation and alliance. But on the corporate side, yes, there's a lot of Japanese investment into the US, but there's this attempt by the Japanese to take over an iconic name in the US steel industry, which plays awkwardly for perhaps President Biden. And we know that an antitrust investigation is now underway there. Is this something, does that detract sufficiently from the broader alliance story?
Right. Well, certainly the timing, that announcement or the news of that probe did strike a rather sour note. It came just before the state dinner was due to start between the two leaders and a whole range of business guests from both countries. So, yes, it's not great, but I think Japan recognizes that this is an electoral issue for Biden, so they are really biding their time for the moment and waiting to see what happens. We heard from our Japanese sources ahead of time that they were not going to raise it directly with Joe Biden, so we'll see how that works out. They're trying in a more subtle way to show that in general, Japanese investment is beneficial, and indeed investment in both directions is beneficial. So we'll see how far that campaign works out.
Isabel Reynolds, our Tokyo bureau chief, joining us this morning for the crucial context around the Japanese geopolitical story with the United States. We thank you so much. And she was talking a little bit about the steel deal as well. We should mention that the Biden administration has recently invested in chips in Japanese factories there as well. The Pacific Command, notably, is very, very underfunded at a time when relations in the South China Sea aren't the best. So there are a lot of reasons that Japan is very important. We had Rahm Emanuel, for example, who's the ambassador there on Bloomberg TV just recently talking about just how bad tensions are between the U.S. and China and the read-through.
Interesting to think about the energy dynamic on this as well, because the U.S. deciding to cut back on LNG exports, certainly something that caught the Japanese a little off guard.
Imagine the Japanese are looking at the Americans, though, and thinking, yeah, that's your currency and that's our problem right now, though.
Yeah.
How are they gonna deal with that, I think, is probably the near-term question that they need to figure out, because it's really interesting. You talked to, it was Blue Bay, the conversation we were having. We were talking about kind of how expensive beers are in London, in Mayfair, New York, and how cheap they are in Tokyo. You continue to see this story where the local domestic population is looking at all these tourists turning up and spending money hand over fist. And one of the reasons for that is that Japan remains epically cheap. There's a political narrative around all of this as well.
How cheap is a beer in Japan?
Apparently very cheap.
Oh, okay.
Yeah, we had it on good authority. We literally went around the world in beer prices. It was very informative. Let's come back here in London and see. I mean, that's the preoccupation of the BOJ, the Ministry of Finance over in Japan, is the weakness of the currency. Interesting to see the focus here in the UK post the CPI in the US. Traders are paring their Bank of England rate cut bets to less than 50 basis points this year. I mean, on some level, it's not surprising, but it goes back to your earlier point, Guy, of to what extent will Europe be dictated by its own dynamics, and to what extent will it be the read across the Atlantic?
I also just think there's a cover story here as well. It was really interesting that we saw that piece from the governor, Andrew Bailey, coming out. It was in the FT. It came out just after Powell was sounding super dovish, and it almost felt like Bailey felt that he had the kind of the Powell seal of approval, maybe to sound significantly more dovish. They are very related in terms of how you think about it. The relationship between the treasury market and the gilt market is significant, and I just wonder whether he felt like he had the kind of the tick in the box from Powell. I can move forward. I can be dovish here. Does he have to start to unwind that? What does the commentary look like?
Well, speaking of the commentary and speaking of the FT, Megan Green wrote her piece, and I thought her argument was interesting. She's saying kind of what the consensus here is, right, that UK rate cuts may still be further on, but she's saying that some of the stickier factors are even more stickier in other advanced economies, whereas the UK actually doesn't have that problem in certain aspects of the inflation story, which is the exact opposite of what we traditionally hear.
Yeah, she's definitely drawing the contrast. She thinks it's important to point out the contrast between the UK and the US economy right now. Not only separated by a common language, was her reference, I'm sure, an experience you perhaps feel daily. I don't know, Christy. But anyway.
Gilt yields are up a lot this morning, and they continue to rise. They're up by 7.5 basis points. There is a big repricing happening in the UK curve right now. And the next set of data are going to be fascinating. The seasonality factor in the UK inflation data is quite dramatic.
Is it just harder to move without the cover of the Fed? Maybe. And that takes us on to the ECB, doesn't it? Because a lot of expectations now around where we go there.
What is Lagarde going to say today? Less about June and more about July. Does that debate get taken off the table? Is June locked in? is July then problematic?
But you know what happens if she says that then? It's then, and I think the initial read-through is she's taking a cue from Chair Powell, like as opposed to targeting Europe specifically because of the read-through there, because Jay Powell had pushed that further as well. That's going to be something we talk about.
I do wonder whether there's a danger of simultaneous kind of mistakes happening. Powell being too dovish, Lagarde not
You're very doomsday today.
Not being dovish enough. Well, in some ways, that's a reflection of a very positive US economy, and maybe less so here in Europe. Coming up, traders pairing bets on that ECB rate-cutting story, driven by what we've seen out of the States. We're going to get more details. What is Christine Lagarde going to say today? What is she going to... How nuanced is the message going to be? We'll find out next. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
This is Markets Today, 46 minutes into our European trading day, which isn't going anywhere yet. We see some movement, actually, on some of these markets, so I shouldn't downplay the CAC 40 move, up around 0.5% right now. Elsewhere, a little flatter, and we are waiting for the ECB. What else are we waiting for? Quick look at the daybook tells us we're going to hear from Megan Green. She's already been writing in the FT overnight. We're going to hear a lot from her, though, over the next couple of days. She'll be speaking in Washington later. We get that ECB decision later on today. We also get US PPI and initial jobless claims. So that's the US data to focus on. And then Megan Green speaks again. She's at an event in Greece. We'll also be thinking about the US 10-year auction.
Megan Green is very well travelled.
I'm not sure if she's physically in both those places.
I think she must be doing, I know she lives here, so maybe she's doing via video link.
Not entirely sure of her movements, but she will be speaking a lot.
She is going to be, and she's got a piece in the FT this morning to kind of kick it all off.
Excellent. So, and then we'll get a number of Fed speakers throughout the day, which is going to be fascinating. To what extent is their thinking evolving as a result of that US CPI data? And President Biden is continuing to host the Japanese Prime Minister. He'll also be hosting the Philippine President, so we'll continue to watch those developments with regard to the Pacific. Back to the macro, though. The ECB is set to keep borrowing costs on hold today at a record 4%. So far, so simple. But what are we watching for? Let's get the take then on the ground. Two different takes here. We've got Lizzie Burden, who is at the ECB, of course, in Frankfurt for us. Jana Randau is in our Frankfurt studio for us, and she leads our ECB and Euro area economics coverage. So let's start with Lizzie. Lizzie, what sense do you get that we could get any surprise from the ECB today?
Well, Anna, only one of the 62 economists we surveyed sees that happening. But you have had lots of murmurings about the need to go early, perhaps not earlier than June. You've had Bank of France Governor François Villeroy de Gallo talking about the need for an insurance policy against the risk to growth. You've had the Greek central bank governor talking about the feasibility of going this week, but it isn't priced in markets. It's barely priced. And even a June cut, the pricing's been pared back since last week because of that hot inflation report out of the US yesterday. Whereas it was looking fully priced last week, now June is 80% priced for the ECB. But you've spelt it out really well here. It's a two-sided risk. On the one hand, if they go before the Fed, there's a risk of euro weakness, which could feed back into inflation here. On the other hand, if they leave it too long, there's a very real risk of euro area recession. And even the most hawkish member of the Governing Council, Austria's Robert Holzmann, has been warning about the perils of waiting too long. So the focus today at the press conference is very much going to be the path beyond June, assuming that June is when the first cut comes.
Lizzie, inside the ECB in Frankfurt, thank you very much indeed. Up the river a little bit is Jana Randau at our bureau in Frankfurt. Jana, talk to me about how Lagarde communicates today and how yesterday complicated the picture and how she's going to remain maybe kind of in a position where she can't give that much. What can she tell us today about the rate path?
Yeah, I mean, everybody is waiting for some sort of guidance, some sort of a signal on where interest rates are headed and when. And that's precisely the complication. And we got a very big reminder out of the US yesterday, of course, with that inflation report, that she cannot really reliably do that because you never know when inflation will throw another curveball or the economy as such will throw another curveball. We have inflation that is coming down nicely in Europe, but we do see domestic inflation pressures still high, driven by wages, and that is partly behind the reason why she wanted to wait until June in the first place. And now, of course, there is a reminder that maybe inflation will not come down as quickly as hoped. And as envisaged, just because wages are continuing to be strong, services prices are continuing to be strong. So really a very difficult challenge for the ECB president today, offering guidance, some reassurance to markets, because the least thing you want is volatility and a lot of second guessing, but at the same time keeping her options open, trying to basically tell everybody how the ECB will decide if a certain kind of or a certain piece of data arrives. I think that's the best thing she can do today.
Jana, what happens after the first rate cut? Is this a monetary policy that could kind of be a start and stop in terms of procedure, or is this one rate cut kind of opens the floodgate to rate cuts at every meeting? How's the ECB thinking about it?
Interesting question. We haven't heard a whole lot about it, and that tells you how difficult it is. Policymakers say, yes, there is not going to be just one rate cut, and then that's it. So there will be several to get policy settings to a more neutral stance, a less restrictive stance. But how exactly that's going to happen, data will dictate. So we might see a few cuts in a row. We might see them just once a quarter, in line with the or whenever new projections come out. All that is very much unclear at this moment. I don't think anybody will know, even if you ask them today, they don't know, simply because data may dictate a faster or a slower path. So very unsure at this moment. But the one thing that I think is clear, that there won't be just one cut.
Okay, yes, we've got a piece out, opinion columnist Marcus Ashworth saying if they delay now, then bigger, faster cuts lie ahead. That's just, his view, but interesting to throw into the mix. Jana, on the question about divergence between the ECB and the Fed, that's given extra spotlight, I suppose, because of what we heard yesterday on CPI in the US.
Absolutely. I mean, there was chatter among ECB watchers about economists yesterday saying, well, if there was any doubt about who moves first, then that went away after that US CPI data. So, the ECB looks like it will go first, unless something else happens, of course, and unless things change and they get information that might delay action here as well. But so far, June still looks like the most likely scenario for a first cut. And then, we'll have to see. The Fed will, at some point, have to cut rates as well. Will the ECB get as many rate cuts in as it had planned originally, or as it had thought? Who knows? I mean, the euro we saw already weakened after the report yesterday. If we see that divergence going on for longer, that trend will continue. At some point, Lizzie mentioned it, you will see inflation pressures picking up again just because of that. So a very fine, delicate balance that we'll need to find in the second half of the year.
Jana, looking forward to the coverage a little bit later on as we build up to the announcement and then that press conference. A little bit of a debrief may be required afterwards. We'll get that from the team. Jana Randau in Frankfurt. We'll bring you that ECB decision. 1:15 UK time is when it drops. 30 minutes later, we get Christine Lagarde speaking. We'll bring that all to you live here on Bloomberg Television. Some great coverage across the wider team as well. Tomorrow, we're going to bring you a conversation with Jean-Claude Trichet, who, of course, is the former ECB president, current chairman of the European Group of the Trilateral Commission. We'll get his take on where we actually sit right now. I want to show you what's happening with European yields this morning, because you are continuing to see that tick higher. These are decent moves that you're seeing tick higher. This is into an ECB meeting, which in theory should be relatively dovish, but isn't. There has been a big gap higher, guys, in UK yield. So the front end of the UK curve has moved quite aggressively this morning. Big move yesterday, which continued after the CPI print, then a gap higher this morning, which has then continued higher too.
In defiance of the Megan Green view, then, perhaps.
I was going to say,
well, maybe actually, I mean, in the sense that there's read across from the US, but I suppose goes along with her view that rate cuts are a long way off.
What do you think that reaction is to, though, on the UK side? What's the canary?
I think there's a bit of green in there. I think Megan's having an effect this morning. Certainly, I think that probably is going to be an effect. People have been watching the vote split quite carefully recently, so she's
not been there all that long. So
no.
Things she says add to our understanding about how hawkish she is, I guess.
Yeah, and then I think there probably is a continuing read across from what is happening in the United States. Can the Bank of England really be as dovish as we anticipated, as maybe the governor gave us a sense that it would be?
Yeah.
Is Bailey going to have to row back some of those comments, those very dovish comments that he delivered in the FT?
Interesting, we will hear from quite a few Fed speakers today. So that'll add some real understanding to the impact of that CPI on their thinking.
I know we're talking a lot about the bond market. To me, it's the FX market. I'm excited for that volatility to come really to the forefront. Does euro-dollar finally crack if we get that early indication that rate cuts are a sure thing for June? For me, that's the story when it comes to the markets broadly. Of course, coming up on Bloomberg Television, you do want to miss our interview with the EU competition chief, Margaret Vestager, and our exclusive interview with the CEO of Telecom Italia. Two massive interviews you do not want to miss. In the meantime, that does it for markets today. The Pulse is up next. Francine Lacqua taking you through not only the U.S. free market, but going into what the rest of these markets are positioned for ahead of that crucial ECB meeting. Stick with us. This is Bloomberg.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Hotter than expected U.S. inflation data forces traders to scale back their bets on Fed rate cuts, with the yield on the U.S. 10-year hitting its highest level since November. Well, attention now turns to the ECB. The central bank is expected to keep rates on hold, but signal that easing will start in June. Plus, our exclusive conversation with the chief executive of Telecom Italia on the company's plan to sell its landline network to KKR for as much as 22 billion euros. Now, first thing is first, I'm looking forward to the interview with Pietro Labriola, but let's take a look at the European markets map, because it is a lot of focus, of course, on what we've seen with rates. The ECB expected really not to say anything unchanged, but the focus then moves to the Fed. Now, calm a little bit restored to the markets and bond markets, I would say, after the crazy U.S. inflation data that we had yesterday that forced investors to really scale back bets on the Federal Reserve's interest rate cuts. Now, energy stocks do seem to be outperforming Europe's little changed. Europe's stocks index is, as a whole, you can see the FTSE practically unchanged. We're seeing a little bit of a lift to that CAC 40, but again, nothing huge. Treasuries, again, little changed after the index showed that the debt in the biggest decline since 2022, while a gauge of global bonds suffered its worst performance since February 2023. S&P futures unchanged. Stocks Europe 600 once again also unchanged. Now, cross-asset, some of the things that we need to look out for is, for example, gold. Also, the index of dollar strength was steady. Yen increasingly weaker to levels not seen since the 1990s against the dollar. That was yesterday. Now we're seeing a little bit of support, but the depreciation has also actually sparked some fresh speculation that Japanese authorities might step into the market to support the currency. And this is on the back, of course, of what we saw with dollars. And iron ore 0.3% higher. Now, onto a big corporate story, and Italy's government says it will support the blockbuster deal by Telecom Italia to sell its landline network to KKR, despite investor concern around the company's debt. Now, the finance minister, Giancarlo Giorgetti, calls the plan the only realistic option. The company has been openly challenged, though, by some minority shareholders. I'm very pleased to be joined now by Pietro Labriola. He's the Chief Executive of Telecom Italia. Mr. Labriola, thank you so much for joining us today. You've had a couple of minority shareholders with big voices saying, look, they'll vote against this, there's concern going forward. Are you positive, 100% positive, that the deal will go through?
Yes, I'm 100% confident, because in any case, if you look also to the alternative, none of them is saying that we have to block the deal. So it means that everybody are confirming that this deal is the only way to give a strategic and industrial new opportunity to our company and to solve once and forever the debt issue. So I'm very confident about that.
And I know you've defended, even on this program, of course, the industrial sense of the deal. Are you also confident that this will be wrapped up by the summer?
Yeah, but sure. And it's not only me. We confirm, but also KKR gave a confirmation to the market that everything is on track. But I think that is very, very important to stress that this is also an industrial deal and not only the solution of the financial constraints of the group. And if you look all around Europe, you are starting to see that there are also other players that are evaluating the breakup by two of the company, dividing infrastructure from services, because these are two different business models that are getting two different paths of growth.
I mean, this is a world premiere, and I know, again, you've said this makes sense and could unlock, future, it could be a template for other companies. But earlier this week, we had leading proxy advisors, such as ISS, but also Glass Lewis, recommending that investors actually vote in favor of renewing the current board on April 23rd. Are you confident that that means that other players that are more reluctant will fall in line and agree with them?
Yes, I think that what was stated by ISS and Glass Lewis is important, both in absolute terms, because it's a confirmation of the good job that we did in the last 2 years, because we are discussing today, but this is a long shot that we started at the beginning of 2022. And we did a great activity to explain why it was the right path. In the second, but this is important also in relative terms, because ISS and Glass Lewis try to compare the alternative to this plan. At the end of the day, what they state is that it's better to stay on the right track of a project that started 2 years ago.
Yeah, and you also have the full backing of the Italian government. Now, if you look at Telecom Italia shares, they're still at quite a big discount compared to peers. Why are shareholders reluctant to buy the stock as much as you think they should?
But in any case, if you know, our stock was a stock that had also, in the last year, a lack of trust by the market. Also because in the last 14 years, our company was able to achieve the target, the guidance, only 5 times. We are trying to recover the trust from the market, because in the last 2 years, for the first time after 14 years, we were able to achieve in 2 consecutive years the guidance. But in any case, as you were mentioning, this is a premiere. What we are doing is something different from what happened in the past. And so everybody is at the window to try to understand what will happen. It's clear that there is this kind of difference from the past, innovation that can hurt someone. And in the meantime, also the fact that in the past we didn't deliver what we promised is putting some people on a kind of wait-and-see solution. Then it's clear that also there were some rumors in the market that the deal with KKR should be delayed. And it gave to a lot of people some fears related to the fact that if it will be delayed, there could be some issue. But to keep everybody in a more safe area, we release a press office on Monday explaining that we are on track, and in any case, we don't foresee any kind of issue also in a case of possible delay. That we don't foresee. We are very confident
so basically,
that the deal would be good.
Yeah. But Mr. Labriola, so basically you're not saying that they're not buying the equity story, is that they're either worried, right, investors, that this will be delayed, and so question mark on what happens, or they're actually worried about the execution of the deal, and this is something that you'll have to prove going forward.
But I don't have to accept to you that continuity is something that is very important for the market. So I think that there will be a lot that are at the window waiting for the General Assembly to see that everything proceeds and there's no discontinuity. But this is not me. This is what also was stated by ESS and Glass Lewis, explaining that the continuity is what guarantees the best for the company. And if you are a shareholder, sometimes we are in the middle of April, you can wait 10 days to see what's happened to the General Assembly. So it has nothing to do with the industrial story. It's something different from the reality.
Talk to me a little bit about the investor firm Merlin. So this is one of the main opponents to the re-election, actually, of the board. Something else that they put in the line is that you should sell Telecom Italia's Brazilian unit. This is something that generates a lot of cash. So what do you make of that proposal?
First of all, it's 2 years since I arrived. Everybody was saying to sell Brazil. If I've been sold Brazil at the beginning, today I should face the issue of all the shareholders that should ask me why we undersold Brazil. If we look so at the industrial story, and then we'll talk about the financial aspect, the industrial story, Brazil, after the sale of the network, will be 45% of our EBITDA after lease. So it will be an important component of a well-balanced portfolio of activity, with Brazil that is a cash cow, team enterprise that is a fast-growing business, and consumer that is a business that must be restructured and merged with someone. So why we have to sell the Brazil losing this well-balanced situation? If you look at the financial point of view, everybody are forgetting that we have on the table 5 billion euro upside that can come from the earn-out from the sale of the network, the sale of Sparkle, and the last, also the litigation with the Italian government. So if you have the opportunity to get 5 billion euro of upside, why have to sell an asset that is an important element in the industrial story? This is what I don't understand.
So you're telling me that's a no. Yeah, so you're telling me that's a no. Do you think you'll be able to get them on side by April 23rd? And the same question is also for Vivendi. That's not opposing the deal, but that says actually the valuation is not high enough.
But I think, as I mentioned also the last time that I gave the opportunity to have an interview with you, is that I'm discussing with all the shareholders, because I think that is important, the convergence of everybody on the best for our company. So again, if I look at the evaluation that are coming from the analysts that are much higher than the actual value of the company, if I consider that none of them have included the potential upside that can come from this 5 billion, if no one is including also the opportunity that we will have to be part of an important market consolidation in the following years, I think that we have the opportunity to allow to this company to be back to grow, and perhaps also to have in the future a shareholder remuneration.
Yeah, and I know you've said it many times that you're working on having everyone's confidence, but are you confident that Vivendi will vote in your favor on April 23rd? This is a very big shareholder.
Yes, I cannot say that I'm confident that they will vote. What is important is, in any case, in the interest of the company, that the slate of the board will be the winner, because it will guarantee continuity for the company. Vivendi is a rational shareholder, and what they want to do, because this is what they declared, is to increase the value of their stake to be sold. And I think that our plan is the best that can guarantee that.
Thank you so much for joining us. That was Pietro Labriola, there, the Chief Executive of Telecom Italia, ahead of that important vote on April 23rd. Now, coming up, traders pair bets on the ECB cutting rates after U.S. inflation tops estimates. We get market reaction from JP Morgan Private Bank's Global Head of Investment Strategy next. This is Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Welcome back. This is The Pulse. Rate definitely in focus. Now, in the last couple of seconds, this just crossed the Bloomberg terminal. Traders pairing ECB rate cut bets to less than 75 basis points this year. This is after U.S. inflation topped forecast. I mean, that sent quite a lot of things moving in the markets yesterday. Now, let's bring in JP Morgan Private Bank Global Head of Investment Strategy, Grace Peters. Grace, as always, thank you so much for joining us. I mean, today, full on ECB watch, but then we also have those producer prices in the U.S., and there's even more, I guess, writing on that, given what we saw with inflation in the U.S. What are you expecting from the ECB?
Yeah, so what we're seeing coming through in the inflation numbers is some divergence. When we look at latest European inflation, actually you've got both headline and core coming in lower than consensus and the ECB expected, and quite the reverse of that yesterday in the US. And as you say, we'll watch for PPI, which will give us that steer on PCE inflation, which is obviously what the Fed follows most closely. When it comes to the ECB later, our expectations, like is priced in markets, is that they are on hold for this meeting, with the first cut coming in June. And in coming to that conclusion, we're looking at both sides in an absolute and a relative context. Inflation, I've mentioned, is lower, absolute, and obviously surprising so far to the downside in Europe. But growth is also much weaker. We do need to watch growth in Europe because it's weaker, but I think it's at that point where it's starting to actually improve. And so that could be something to watch on the inflation front. But I just don't think the ECB are going to have the information, particularly after yesterday's US print, to feel that this is, the meeting at which they need to first cut rates.
I just find it incredible. Like, if anyone had told us at the beginning of the year that there would be this divergence between what the Fed would do and the ECB and even the Bank of England, I don't think anyone would have believed them.
No, I think that's fair, and the main delta in that is US exceptionalism around growth. And therefore, central bank policy, and obviously that's feeding into FX and into rate markets and equities as a result of that. So no, I think that's been quite stark. But my sense is, as I say, globally, you are starting to see growth starting to lift across the board. Now, I don't think Europe's going to get anywhere close to US growth rates. The US is benefiting from a surge in immigration, increased labour force participation rate. All of that is boosting consumption. And I think those dynamics are not in play in the Eurozone to the same extent. But I do still think growth will lift in Europe as we go through this year.
I mean, is there a discount because of political uncertainty in Europe? I know there's the European parliamentary elections. Don't get me wrong, there's a big election in the US as well, which could change the trajectory. But is it discounted in the market right now?
So the European market is trading at a 30% discount to the US. It's been that way for quite a while, so I never see valuation alone as a reason to buy into an equity market. You need a catalyst. And I think when we look to Europe, which is a market that we are favourable about, particularly the larger cap multinational companies, the two catalysts that I'd point to is firstly this modest recovery in growth, and the fact that the ECB, we think, are going to cut rates before the summer, and that should be a catalyst for risk. The second thing is when we look at European balance sheets, they are totally transformed. We're actually in a situation now where rather than European companies being a net issuer of stock, rights issues and the like, that many still carry a lot of baggage when thinking about Europe, particularly European banks, around net issuance. Actually, Europe is buying back stock at a rate faster than it has in a very long time. And so when you look at the dividend and the share buyback yield, that total return story is stronger for Europe than it is for the US. So a couple of catalysts there that I think will prove interesting this year.
But if you look at the ECB, do they have to work that much harder if they're going against what the US does? So we're expecting something in June. I mean, the market repriced to about 75 basis points in total. I mean, maybe do they need to work harder?
I think that they'll be more mindful of making sure, obviously all the central banks are looking for evidence that we're on a sustained path back to their targets when it comes to inflation. And we saw very strong disinflation in the US through the fourth quarter that's obviously now starting to stabilize a little bit with these 3 inflation prints that have surprised to the upside. So I'm sure the ECB and the Bank of England will be watching that, and it just brings in that extra note of caution, which I think is what the market's pricing today. And then obviously rate differentials as well as growth differentials are a key driver of currencies. And so that will be another thing.
I was going to ask you how you play the currencies actually in this kind of environment. We've seen some huge, and then I'll ask you about yen and also some of the, renminbi in a while. But if you look at euro dollar, does it make a difference in what kind of companies you want to be invested in?
Yes, I think, just in terms of the FX impact, certainly dollar strength with US exceptionalism feels more likely. I think in theory, Europe, when we look at particularly those large companies in Europe, many of them are exporters. And so, euro weakness in theory should help. But these things are always actually really hard to map because of hedges and everything that companies have in place. But I think that recovering European growth dynamic equally could support the euro. So I think actually when we're thinking about FX, it's probably one of the hardest asset classes at the moment to balance. But whether it be in fixed income or in equities, I think there's a good story to be had for Europe at present.
Grace, when you look at US debt, and this is one of the big questions, is there going to be a credit event? And I know everybody ignores it, and then for like 2 days, every couple of quarters, people freak out because of someone from the budget responsibility saying something in the US. It's amazing that it hasn't really come into the US election yet.
No, it is absolutely one of those factors that we're all watching and that we know is on the horizon and does cause fluctuations in markets, as we saw last summer, really, when you saw the US debt downgrade and yields move significantly higher as it priced in that term premia. I think whoever's in the White House, there aren't indications yet that either of the most likely candidates want to really tackle the debt problem. And I think markets are pricing a reasonably benign outcome at the moment. But it's one of the reasons when we're thinking about our fixed income exposures that, to be either shorter duration or neutral duration feels comfortable, but it's one of the things that argues against going very long duration, given the inflation, as you say, and the debt dynamics.
Grace, thank you so much. Grace Peters from JP Morgan Private Bank stays with us. We'll talk a little bit about yen intervention. That yen intervention watch continues as the currency slips further past the 153 level to the dollar. We'll discuss that next, and this is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back. Now, Japan has warned that it will consider all options after the yen slumped past the 153 level. Still with us, Grace Peters from JP Morgan Private Bank. Grace, we talked about intervention, so we're looking at China and of course, Japan because of the currencies. What does that mean for your investment portfolio with Japanese equities?
Well, we just spoke about investment opportunities in Europe, and I think when I add to what else is interesting outside of the US, where, post the inflation print, I think equities could be a bit more range-bound in the US. So Japan is another region that we think benefits from improving global growth and a strong domestic story. And the domestic story is very much around, an element of reflation for sure, but really it's the shareholder return story when you think about the cash that's been trapped for a period of time on Japanese company balance sheets, but now actually there's incentives to start unleashing some of that capital to shareholders, which is quite important.
And that's across all sectors?
That's across a large number of sectors. And when you look at market valuations on 16 times forward earnings for Japan, that number encapsulates the cash. So actually, i.e. the market is ex-cash cheaper than it looks on a headline basis, demonstrating earnings growth benefiting from the domestic and the global recovery, and as well that improving shareholder return story. So I think that's going to get quite a lot of attention still.
Grace, thank you so much. Grace Peters there stays with us. Of course, next, Bloomberg UK as traders pair bets on Bank of England rate cuts. So we'll talk about the BOE. We'll also talk about the Bernanke review. That's coming up shortly. And this is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services, and markets. I'm Francine Lacqua here in London. So traders have pared bets on Bank of England rate cuts to less than 50 basis points this year. Markets now expecting the first quarter-point reduction by November. Well, I'm very pleased to be joined by Grace Peters, Global Head of Investment Strategy at JP Morgan Private Bank, also joined by Anna Andrade from Bloomberg Economics. So we'll talk about BOE and, of course, the investment case for the UK. And Anna, I know you're also looking at the BOE's Bernanke report. So Ben Bernanke was tasked with looking at communication skills, and actually that report, the much eagerly awaited report, finally comes out tomorrow. So why is the bank doing this?
It commissioned this external review to sort of fence off criticism of its failure to anticipate the biggest inflation shock in a generation. And at the beginning, that was what was intended, the Bernanke would look at the forecasting processes of the bank and see if there was something wrong with it. But we've wrote a lot about this, and we look at the forecast record of the BOE, the ECB, and the Fed, and we actually see that there's nothing particularly wrong with the BOE. The scale of the forecast errors was very similar across the three central banks and also close to our own forecast errors in the private sector. So what we think that the report will focus on, it's not so much on the ways to improve the forecast, because forecast errors are sort of inevitable in the area where we're in, but more on the communication of the BOE, because the BOE, I think one of the challenges of the BOE's communication is that it doesn't really give markets a say about what it thinks it's the right path for rates over the long term.
So how do you implement the changes? I know there's been a lot of talk about, for example, the dot plot, which, for example, Catherine Mann was really pushing back against that and saying, look, you have a median average, and actually it's much more transparent than even what the dot plot would give you.
Right now, how the bank communicates what it thinks about the rate outlook is that it produces two forecasts. One forecast for the economy and inflation based on the market path for rates, and one just assuming that rates stay unchanged over the next 3 years. And we have to sort of deduct from those two forecasts what the BOE is thinking that is the appropriate forecast. And as you can imagine, it's sort of unnecessarily complicated. So we think the single best recommendation that Bernanke could do is to suggest that the BOE changes into producing its own forecast for rates. And it doesn't necessarily need to be a dot plot like the Fed does. I think that will be operationally complicated. But it could just be something like the Riksbank does, where it produces a central base for the rates based on sort of a model and on what's appropriate monetary response, also with some judgment. And so that will give us more clarity on what the BOE is thinking.
And I want to ask you whether you think these changes will take a while in a second. But Grace, would that be useful for you? As market participants, would it actually make a meaningful difference to how you evaluate, monetary policy of the BOE?
I think it would be helpful to the market, because we've seen, using the Fed as an example, how that forward guidance is something that the market prices almost immediately. It's the forward guidance that can make its way straight through into market pricing across asset classes. So I think that would be a helpful development.
So if you look at these changes, how long will it take to implement them? Whatever happens in that review, or whatever we see in the review.
I think historically, the BOE has taken its time to implement the changes. The WARSH review from 2014, the BOE sort of took 8 months to implement. I mean, Bernanke is not going to come out with just one suggestion. It's going to come out with a big list of suggestions, and the BOE will sort of choose what it wants to implement. But now we also know that Clara Lombardelli is going to be in task of supervising the implementation of the recommendations, and she's only going to start her mandate in July. So that means that it's definitely a question for 2025, and it will start way after the BOE, in our view, starts getting rates, which is in June.
It's interesting because someone like Mohamed El-Erian, who has given, frankly, the Fed hell, is really pro what the BOE has been doing in terms of communication, because he says, look, sometimes they just don't know, and it's refreshing and useful for the markets for a bank to say, we just don't know.
I agree, but I also don't think, and I think that's also why there's some resistance within the BOE into moving to produce a central baseline for the rates, because they're afraid that will be seen as a promise. But I think markets change view all the time, economists change view all the time, and the Riksbank, it hasn't hurt the Riksbank credibility to sort of produce this. So I don't think it would have adverse consequences.
Grace, what's your take overall about UK equities? So we're also in an election year, a lot could change, and yet both parties seem to say that they're quite friendly to business.
Yes, I think UK equities are actually one of the most unloved parts of the market, and it's been that case for a period of time. But when we're thinking about drivers of the UK, there's no doubt that the UK is starting to see a bottoming out of growth. The PMIs in the UK are actually some way into expansionary territory. And, when we look at, I know you were reporting on housing data earlier, there's quite a few signs that the UK is improving, which would be good for the domestic parts of the economy. And of course, the UK equity indices is also very global. A lot of oil companies, with the oil price up where it is now, that's helpful for their earnings and dividends, and mining companies as well. So I think for those looking for unloved and contrarian options, the UK is quite a good place to look.
Just the bigger companies, or there was always a question about the FTSE 250 and actually what kind of value that gave you?
I think the FTSE 250 is still very domestic, so I would prefer to be in the FTSE 100, where you get that mix of, yes, some exposure to banks and home builders that are domestic, but you get the international stream as well. A real kicker for me, if the FTSE 100 were to, what would be the catalyst for the FTSE 250, it would be an increase in M&A for some of these smaller companies, whether it be public-private or international buyers. That's always seen as a real sort of bellwether when M&A picks up. That would be a great catalyst to look at the FTSE 250.
And what are you expecting? I know there were traders were pushing back for this full 25 basis points BOE rate cut to November. I mean, it just keeps on being pushed backwards and backwards. But I wonder whether that's Fed, concerns rather than looking at what we're seeing domestically.
I think it's mostly Fed concerns. I think there's a big question now is, are we going to see a divergence in monetary policy between Europe and the US? I think we will. I think the story is different between the two. I mean, if you want to look at data, we can just start with the data. Data since the start of the year has surprised to the downside consistently in Europe. In the US, it has gone in the other direction. Core inflation, momentum of core disinflation is actually stronger in the UK than it is in the US. The 3-month on 3-month annualized rate is 2.5. We estimate it's 4.5 in the US. And then history also tells you that the BOE doesn't always follow the Fed. It started hiking 6 months before. In 2016, it eased when the Fed was hiking. So there's some concerns about the exchange rate channel, that if the Fed doesn't hike and the BOE doesn't cut, and the BOE does, that the pound depreciates, and that can bring inflation. But the pound moves, or the inflation depends on a large basket of currencies. The US dollar only accounts for 20% of that, so
I mean, it's quite
not
funny.
Significant.
And the only question that Governor Bailey never answers is actually the gravitational pull of the Fed, which is what we were talking about, also in relation to the ECB. How much harder does it make it for the BOE because of some of the concerns you were outlining, especially sterling?
I think it makes it harder, and it doesn't. I mean, they probably would prefer that the Fed also start. It will make sort of the communication across the globe easier. But there are specific things to Europe that the US doesn't have, the energy is a massive source of disinflation that the US just doesn't have. And here in UK, we're going to see energy prices in the CPI falling by 12% in April, 8% in July. You know, these are big movements. And also the economy is just weaker. It's just below potential, which is, it never got to that point in the US. So if the policymakers focus on those areas of divergence, I think they can still communicate effectively.
And Grace, you mentioned M&A. Do you think there's also, a pull from investors, given the UK seems relatively stable, maybe compared to other democracies right now? Are we going to see more money into the country, or is that
so? We hope so. I think I mentioned before it was more of a contrarian and unloved place, but it's also, a location with an absolutely super capital market. So we really very much hope, and I think the early signs are that M&A is coming back broadly and that the UK will be included within that.
Thank you both for joining us. Grace Peters there from JP Morgan Private Bank and Anna Andrade from Bloomberg Economics. Now, coming up, we'll be discussing the future of the City of London and its role on the global financial stage with Javier Blas. More on that next, and this is Bloomberg.
Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Season is coming.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA. A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
It all starts Friday on Bloomberg. Context changes everything.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, ever since Brexit, the City of London has been worried about its declining role in global finance. Now, those concerns came to a head when the London Stock Exchange failed to win last year's biggest global IPO, that of chip designer ARM, which happened to be British. Now, there are also fears of existing companies looking elsewhere in search of higher valuations. Well, Shell's chief executive says he's looking at all options for its listing. Now, let's get more on this story with Javier Blas, our columnist for Bloomberg Opinion. Javier, I'm so happy to have you on TV because, first of all, you know these chief executives personally. So when the chief executive of Shell says, look, he's looking at all options, is he really thinking about leaving the UK?
I think that we need to take, while someone has been about a year, a bit more than a year into the job at Shell, And I think that we need to take him very seriously because I think he meant it. He is making very clear that his first priority is to fix the company, and he's embarked in what he calls a sprint of cost-cutting, of shedding units that they are not performing well, as reassuring investors that delivering dividends is his biggest priority. This sprint started in June 2023. We are about to be, and it lasts 10 quarters. So by the middle of 2025, we're going to know whether the sprint is working or not. And he says, I think that this sprint is going to help us a lot in terms of valuation. But if it doesn't work, and we have done it, and still we see a valuation gap with New York, then all options, and he repeated to me on the interview, all options need to be on the table. And my question to him when he was referring to all options was, are you prepared to take the shares from London into New York?
And his answer was? All options are on the table. All options. So that I mean, at the moment, the priority is to fix the company. I don't think it's an issue for 2024. But when a CEO of a company the size of Shell, and that's the largest company on the FTSE 100, goes on the record and says that all options are on the table, I don't think that anyone should think that he's bluffing. So you spoke to him in Houston. Why does he think there's a problem with the UK? Again, when you speak to a lot of chief executives, they say, look, it's coming back. Maybe there was a problem with Brexit. Maybe the capital markets was not as mature. But this is something else.
It's completely something else. I mean, I don't think that Brexit has generally helped, London PLC, if we put it that way. But here is that just in Europe, he finds that investors are not interested in fossil fuels for a number of reasons. ESG, climate change is one of those reasons. And he looks at different metrics, and it doesn't really matter what metric one chooses to look at between American-listed companies and European-listed companies. But he, for example, looks at the yield on free cash flow. Shell is trading, I checked this morning, around 12%. Exxon is trading around 6.5%. The lower the number, the better. And then you look at, you could say, oh, well, Shell has its own problems, but look at year-to-date performance from Exxon, up about 22% on the New York Stock Exchange. Shell up 11.5% year-to-date. There is a big difference. And you could say, well, the business perhaps of Exxon is a bit better than the business of Shell, but I think that the difference is too large to explain use on simply the business of Exxon is better.
So this is a free cash flow yield, and basically the higher the yield, as you say, the lower the stock's valuation. So why is BP at almost 16%? Is there a problem with the business?
I think that, look, the European, particularly Shell and BP, for the last few years have been trying to serve what I say two masters. They have tried to achieve the center ground in global oil. And the center usually works very well in politics. That's where more votes are. But for big oil, European big oil, and particularly BP and Shell, because Total in France have opted for a bit of a more nuanced strategy. But you look at Shell and BP, they try to be a collection of oil and gas and then some renewables. For investors who were concerned about climate change, at the end of the day, they were still fossil fuel companies. They didn't care about how much they were investing in wind and solar. They have an oil and gas business. They will not invest there. And if you were an investor who were interested on fossil fuels because you see a future for oil, and also you see even if oil demand peaks, you see the amount of cash that these companies can generate, you don't really want them to spend money on wind and solar, which are low-yielding businesses. So they were not really interested. And at the end, they tried to serve two different masters and got none.
But so how difficult would it be actually take Shell, take it out of the FTSE and put it on New York listing?
Very difficult, because, this is also very important. This is not the first time that Shell have looked at this. We knew, because, executives talking private, et cetera, but this is, I think, the first time that while someone went publicly on the record and say, of course we look at this. In 2021, 2022, Shell relocated his global headquarters from the Dutch city of The Hague back into London and ended the dual listing structure with a primary listing in the UK. And at that time, the company looked at what if we don't just go from The Hague to London? What if we go from The Hague to somewhere in America, both the headquarters but also the primary listing? At that point, the main concern the company had was, I don't know if we have the investor support for this. we need 75% of the votes, and 40% of our shareholder base is in the UK and Europe, continental Europe. It's going to have the same problem if it comes in the future. I mean, how many shareholders in the UK are going to vote for a relocation to New York? Big question mark.
Javier, thank you so much. Javier Blasser, columnist for Bloomberg Opinion, actually stays with us. Now, be sure also to subscribe to Bloomberg's In the City podcast that I host along David Merritt on Apple Podcasts, Spotify, or wherever you get your podcasts. New episodes drop every Thursday. We have plenty more to come, and this is Bloomberg.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television. Could face bigger challenges.
Was going to keep rain World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Welcome back to Bloomberg UK. We're back with Javier Blas from Bloomberg Opinion, who's still with me. Javier, we're talking, I mean, you have a terrific piece out today that basically says what we should worry about, or what UK policymakers should worry about, is not really gain too much market share, is just not lose any, because you say there's a real possibility after your interview with the Shell chief executive that all options are on the table, including a listing to New York. I mean, what does that mean? If someone like Shell decided to, move to the U.S., do you have BP, Rio, and all the other commodity companies leaving the UK?
mean, the natural resources sector has been always a staple of the FTSE 100. The London Stock Exchange was in many ways the kind of the great capital raising place to finance projects of natural resources, whether it was a copper mine in Chile or, the trade of oil with the Far East many decades ago. And now that is going to be in question mark. I mean, you have Shell, largest FTSE 100 company, opening the door of potentially moving. I mean, I say potentially. if that was to happen, the pressure on other natural resources groups that they are not really favored by investors, I think it will be very, very strong. I mean, if Shell moves to New York, would not investors be asking why is BP still in London? I know BP perhaps have a more attachment to the UK. After all, was British Petroleum. What about Glencore? It has a massive coal business. The company has said that if they spin off the coal business, the listing of that business will not be in London, it will be in New York. Can it happen that actually they don't spin the coal business, that they just relocate the primary listing of Glencore out of the UK into the US? I think that those are important questions, and those are Shell, BP, and Glencore. Those are 3 of the top 10 companies in the FTSE 100. We are not talking about a small startup IPO choosing the NASDAQ rather than the LSE. We are talking about 3 of the top 10 largest companies in London potentially leaving. And I think that the risk is a lot higher than policymakers and exchange executives seem to appreciate.
I mean, we had a conversation with, the chief executive of the LSE with a number of things that they're trying to put in place because of a commission looking at how you attract talent, how you attract capital markets and investment. Is there something that they could do now to make sure that the companies stay here? Or maybe, we're in an election year. Is there something that the government can do now?
I mean, I think that a lot of our pension funds and invested in companies that they are from overseas, so trying to tweak taxation in a way that is more positive for people who are saving for their pension to invest in the FTSE 100 that are putting it in, say, global indices. I think that could be a step on the right direction. But there is a big problem for the exchange because a lot of this is not about, there is a problem with the exchange. This is about the attitude of European investors towards fossil fuel industry. It's simply very different to be here in Europe, and particularly in continental Europe, where some pension funds have said, sorry, but we are not going to invest in fossil fuels, period. That's very, very different to when you go in Houston.
But so some, Javier, would say, well, good riddance, if you can make up for it with other companies.
Absolutely, that could be. But the problem I see for London is where are those other companies coming? Because if you are not really attracting new IPOs from, say, the startup because they prefer the NASDAQ in New York, and you are at risk of losing your traditional big industrial conglomerates very heavy on fossil fuels, what's left? I mean,
are there renewable companies? Are there enough? Again,
I don't see that. The profitability of those companies is not there. We are not seeing a lot of interest for investors. I mean, some of the renewables companies in Europe have had a really terrible 12, 18 months, and you cannot really run a stock market just based on supermarkets.
Well, because they're quite small. I mean, that's also true, unless you really like to buy cereal and bananas. But is there anything? I mean, is there any renewable company that could rival, for example, a Tesla or an EV maker?
I don't see it. I mean, the big renewable companies perhaps could be coming from the automotive industry. I mean, we do have some national champions in Europe on the renewable power. I mean, I'm thinking of companies like Enel in Italy, Iberdrola in Spain. Those are big companies on those particular home markets. But I don't think that we have anything the size of Shell. I mean, this is the largest FTSE 100 company. It's very difficult to replace that.
Javier, thank you so much. As always, so exciting to have you on TV. Javier Blaser, a columnist for Bloomberg Opinion. Now, another reminder to subscribe to our podcast, In the City. It's out today. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Good morning from our world headquarters in New York. I'm Manus Granny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
The hot CPI in the U.S. jolts markets, shredding Fed cut bets, pushing U.S. 10-year yield above 4.5% and sending the yen to a 34-year low.
Next up, it's the ECB set to stay on hold as traders pair rate cut bets to less than 75 basis points this year. We're live in Frankfurt.
And oil's also in focus as the U.S. warns of an imminent strike on Israel by Iran or its proxies. A very good morning. I think the key word is shredded. We've shredded rate cut bets, not just in the U.S., but all the way around. Just take a look at this. As far as 10-year government bond yields are concerned, we popped by over 20 basis points yesterday, Danny, and we tick higher this morning. We're above 4.5%. You're looking at a real momentum shift in these markets. The bears have morphed into an all-out assault on the bond market. If there are no rate cuts or even a rate hike, as Larry Summers said, that could be a tail risk. 15 to 25% of the next move from the Fed could be a hike. What would that do to bond yields? Certainly, if there's no rate cuts, people are now talking about 5% up there. The 10-year government bond auction, it took a lot to get it away. It was one of the worst ones in a number of months. You've got 30-year paper coming to the market today. We are now in the twilight zone of 2 rate cuts, no rate cuts. You're looking at dollar-yen. This was a blistering bid for the dollar yesterday, and nowhere is it more manifest than in the dollar, up over 1% at one juncture against dollar-yen. Today, we have more rhetoric coming through from Suzuki, watching with a high sense of urgency. That's the finance minister. And Candace stopped short of talking about bold moves, but the next watch will be intervention watch on dollar-yen. Oil is up 1/3 third of 1%. Again, we are waiting to understand what is an imminent strike on Israel. Oil bid up third of 1%. Danny, good morning.
Good morning, Manus. It is so clear that inflation has not yet released its grip on this market. Equities weren't spared. The worst of the moves were in the bond market, but we did see an equal-weighted version of the S&P have its worst day in 2 months, and that continues today. We're down by about 1/3% for the S&P. We're also in the scenario where things with weaker balance sheets, small caps, all of those perform worse, falling more than 2% yesterday. They fall by nearly 0.5% in the futures market this morning. We are at a low so far for the futures trade. Now, the NASDAQ hasn't done as badly. It is down 0.2%. Man, as you pointed this out to me, NVIDIA was up nearly 2% yesterday. I mean, it's crazy stuff. We did hear from Jefferies, David Zervo, saying that risk, it can do okay if the Fed's not cutting because the economy is doing well. That's why the Fed isn't cutting. And in that scenario, you can buy stocks. But man, I really have this feeling that it's deja vu, that it's 2021 all over again. It is yet again a scenario where bonds and stocks are falling in tandem, that you need to look to commodities to hedge your risk, that in the market, only big tech things like NVIDIA are doing okay. It is that inflation resurgent playbook come to life yet again.
And certainly brings you back to what Maria Vetman had to say at State Street, which is the barbell approach. Cash on one side of the barbell, big tech on the other side, and there's no irony lost on anybody that NVIDIA managed to hang on to a 2% gain. But then you listen into what Larry Summers has got to say, and it really does make for interesting reading. He has flown this kite before, which is maybe the next move from the Fed, could be a hike. I don't think that that is a coalescing narrative. But what is a much more interesting narrative for the bond market to grapple with, which is no cuts from the USA. What does that mean for global central banks? We have a global bond market rout going on. Bunds are offered all the way down. Gilts are offered all the way down as well.
Remember all those people that told us that 2024 would be the year of the bonds?
Yeah.
I feel for them this morning. I really do.
Well, there is one or two people who still believe that now is when real money come in. We can debate that through the next hour. We're talking about this hot CPI signal and the delay for the first rate cut from the Fed. President Biden stepped into the melee. He spoke about the data and when he sees the central bank cutting.
I do stand by my prediction that before the year is out to be a rate cut. This may delay it a month or so. I'm not sure of that. We don't know what the Fed is going to do for certain. But look, we have dramatically reduced inflation from 9% down to close to 3%. We're in a situation where we're better situated than we were when we took office.
Joining us now is Ludovic Sobran, Chief Economist at Allianz. Ludovic, good to see you. So the bears morphed into an all-out assault on these bond markets. We're now talking about 2, possibly even 0 rate cuts. There is a non-negligible chance of 0 rate cuts from the Fed. Do you think that that is a non-negligible risk? Good morning.
Good morning. I think the Fed will cut this year. The question is, whether we have to wait for September. And indeed, we had initially expected 3 rate cuts, and now it looks more and more like 2 rate cuts. So from my side of the pond, that puts the ECB in a pickle. I think it's good for the US. It means the no lending scenario is actually the one winning right now. So I think it's going to be hard for the Fed to tilt in June, July. It's going to be hard, but let's. I guess high yield investors would welcome that. Let's put it this way.
Yeah, I love you finding the silver lining, Ludo. That's why we have you on, to have some joy in a day where bonds are experiencing their worst rout since September 2022. Look, we're going to get to the ECB in just a moment, but this idea that the Fed would have to wait until September or November, Ludo, that's when we're literally in the midst of a U.S. presidential election. Is the Fed really going to start a new cycle, a new cutting cycle? I mean, surely it doesn't make them look great if they start to cut in September.
That was, for me, that's the ultimate reason why we keep our July cut or late June cut. I mean, the idea is just to decouple from the elections. The question then is whether they could cut and pause and cut and also make it even more gradual than any loosening cycle. Again, remember, if Trump gets reelected, he reheats the U.S. economy and the Fed may have to halt its loosening cycle anyhow. So the question is whether there is a need to front load some of those cuts or whether we can sit that one out. And that would push the Fed all the way to 25. That's why the market is so divided. You really have 50% of the people that think that they're going to cut in July and 50% of the people that think they're not going to cut at all now, which is really crazy if you think about the divergence. I'm still in the camp that they will have to cut. And so you're right, they may cut before the summer, but the numbers are so good, you know. It's hard to cut now.
It is hard to cut. It's hard to justify that cut. And I think that's where Larry Summers was talking about. It would be an egregious mistake to go in June. Now, you know, you started with Europe, so we'll give you that moment. I mean, the market is re-rating.
It's our day. It's our day.
No, okay, don't worry.
One day a week you can talk about.
Don't worry, but you've now started using language like a pickle. So I think you've been in the UK a long time. Right, let's focus down. The market, the bond market has already begun to reprice. No longer pricing 75 basis points. What does Lagarde need to do? I mean, Europe needs these rate cuts quicker and earlier and in bigger size than the US. What has Lagarde got to do? Has she got to keep the June dream alive?
You need to give a call to a friend, Jay. No, the big issue is, look, it's a big discussion here because it's a bit like Schrodinger's cat, you know. The ECB, the Governing Council, may have to cut, not knowing what Powell is going to do 10 days later. So it's going to be a bit of a Pascal's wager, you know. And for me, it's very complicated because even though we want to be independent, we know, and we talked about this together not so long ago, it is the U.S. financial vortex is inevitable. So I do think there are all the reasons for the ECB to cut in June. There are all the reasons for them to cut maybe only 50 bips this year. So again, to cut and pause and cut again and pause. But, you know, it would be this fear of going first is really anywhere you talk to investors and they see this big interest rate differential looming. They see the dollar going stronger. They see this idea that maybe, you know, a tech ETF is much better than any government bonds in Europe, right? So there is a risk a bit of I wouldn't say capital flight, but of a desynchronization of central banks that would be hard to swallow for Europe. But you know what? We have to cut. I mean, for us, it's almost impossible not to cut because services inflation is sticky, right? But all the rest is going down quite fast, yeah?
Okay, so can you just walk me through that scenario? So let's say they cut in June, they get more momentum or they keep cutting. The Fed doesn't cut, they stay on hold in 2024. What does that capital flight actually look like? What's the worst case scenario that the ECB would have to avoid?
I mean, the sensitivity is the following: 100 basis points difference on the interest rate differential is 4 to 5% depreciation on the euro dollar. So it's quite massive, right? But more importantly, my concern is indeed this idea that markets could be spooked that the ECB threw the baby with the bathwater a bit early. And that we still have stagflation risk looming. Again, for us, the reason why we have cut, pause, is because the upside inflationary risk from imported inflation, from supply side inflation, are so high in Europe compared to the US, trade choke points, I mean, you name it, energy, you know, you see the oil prices go up, that they will have to do it very gradual. If the Fed doesn't do, and they keep being gradual, the difference is indeed only 50 bips. So it's maybe 2% on the euro dollar. So it's not a lot. But, you know, it's still quite a bold move. And so I would be worried about market overreacting to this more than the actual effect in the direct, I would say, lending or financial difference between the US and the European market.
In terms of the energy complex, it's something that is perhaps a little bit more pressing in Europe than it is here in the United States of America. To what extent might that, because we're readying the headline over the past 24 hours, we're readying for the response mechanism from Iran on Israel. We don't know where the next escalation is in oil prices. $100 oil notes are coming into my inbox. How much more of a pressing issue for the ECB will the energy complex be relative to the Fed?
I mean, look, in Europe, a $10 additional on the barrel is almost a 1.2 percentage point of additional inflation. And it's half that in the US right now. It's just, that's the way the sensitivity works. So it's not necessarily good news. Again, you know, one could say it's non-core, it's not, you know, in the ECB's mandate. But the reality of the things, people are really looking at this volatile component of inflation to actually decide the pace, not necessarily the moment of the cuts. I think the moment is still pretty clear right now, but the pace of the cuts. And so, you know, more vibrant energy markets could mean that the ECB may be allowed to cut once this year. And that would be also quite a drag when you look at growth forecasts, because we have really muted growth, at least over the first half of the year. And there is this hypothesis of a rebound on real income on the second half that would be completely annihilated should we have another energy shock. Yeah.
Right. Okay. Well, Ludo, I think we gave the ECB appropriate amount of attention here on the ECB
Please.
day. We didn't do too much of the
know,
U.S. Ludo, we're going to have to leave it there. Thank you so much for joining us, Ludovic Subran of Allianz. Okay, Mana, some breaking lines crossing the terminal on Ukraine. Ukraine says that Kyiv region's largest power plant has been destroyed. It was destroyed by an overnight Russian cruise missile attack. That's according to Interfax. Fires are currently being extinguished at the power plant after it was set ablaze. It is a state-run electricity and heat producer, and it operates 3 power plants in central and eastern Ukraine. So that power plant has been destroyed in a Russian missile attack. Okay, let's get to some of the other top stories that are trending on the terminal this morning. KKR is said to be weighing a sale or IPO of BMC Software, which might be worth about $15 billion, including debt. Other private equity firms have shown interest in potentially acquiring the Houston-based company. Meanwhile, no final decisions have been made. KKR still favors an IPO of BMC, which filed confidentially last year with the SEC for a listing. Later today, Bloomberg will be speaking exclusively with the co-CEOs of KKR after their investor day. That's shortly after 10:30 a.m. Eastern.
The U.S. Justice Department has reportedly opened an antitrust investigation into Nippon Steel's takeover of U.S. Steel. Politico cites people with direct knowledge of the matter. Earlier, President Biden reiterated his support for U.S. workers opposed to the $14 billion bid. Speaking alongside the Japanese Prime Minister, Biden stopped short of repeating his call for continued domestic ownership.
President Biden says he's watching Israeli Prime Minister Benjamin Netanyahu's response to what he calls a blunt message on improving civilian conditions in Gaza. Speaking at the White House, Biden also urged the adoption of a 6-week ceasefire in exchange for Hamas releasing hostages and for Israel to open an additional crossing for aid into Gaza.
I have been very blunt and straightforward with the Prime Minister, as well as his work cabinet, as well as the cabinet. And the fact of the matter is that Bibi and I had a long discussion. He agreed to do several things that related to, number one, getting more aid, both food and medicine, into Gaza, and reducing significantly the attempts, the civilian casualties in any action taken in the region.
Coming up, we'll talk energy markets. Brent climbs above $90 a barrel as markets brace for a possible Iran strike. More on that story.
And Intervention Watch, more fallout from the CPI. Japan warning that all options are now on the table to help strengthen the yen, trading above 153. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Welcome back to Bloomberg Brief. I'm Danny Berger alongside Manus Cranny in New York. So oil is steadying this morning, but Brent crude did push above $90 a barrel. And that happened while the U.S. is said to believe that a major attack on Israel by Iran or its proxies are imminent. Let's bring in Bloomberg's Will Kennedy for more on this. Will, how much of the scale and scope of how much further oil prices go from here depends on what that action actually looks like from Iran?
I think that's exactly right, Danny. Clearly, political risk is a concern, and the risk of an escalating conflict between Israel and Iran, either through proxies or more seriously directly, is a concern for oil traders. And what you've got now is a market that's fundamentally tight, where demand is healthy and supply is constrained, and you're layering significant geopolitical risk on top of that, and that's what's given oil its really strong run in recent weeks. It's always worth remembering, however, that conflict in Israel does not directly impact any oil production, and in fact, the worsening situation we've seen in the Middle East hasn't taken any production out of the market. But what traders are always concerned about is that the conflict between Iran and Israel spirals out of control and leads to some kind of event that constrains supplies out of the Persian Gulf.
Well, and it is interesting that you talk about the Persian Gulf because, of course, Iran's Revolutionary Guard has said that it won't block the Strait of Hormuz. I mean, that's the line today. That's Golnar Motovali's reporting from yesterday. Well, talk us through the capacity of OPEC to respond in a, to quote somebody else's words, in a preemptive and a proactive manner, which, of course, is how quickly could OPEC Plus respond to add barrels to this market to keep us below $100 if that's what they so want, or if there's an extraneous event? Saudi has the capacity, the Emiratis have the capacity. How quick is it to turn that tap?
They can do it if they want to do it very, very quickly indeed. And of course, one of the reasons why oil hasn't, one of the things keeping a lid on oil prices is the fact that right now Saudi Arabia and the Emirates do have a lot of spare capacity. Saudi Arabia is producing 9 million barrels a day. That's a very low level historically. They have the capacity to go up to 12 million barrels a day. So they're keeping a lot of the market. I don't think there's any expectation, unless things really do get more serious, they're going to do that before the June meeting. But that June meeting is becoming a pivotal point for the development of the oil market over the rest of the year, with everything that involves for the interest rate and inflation outlook and the US election. So I think as we talk about this in the weeks ahead, we'll all be talking about what OPEC, what Saudi Arabia does at that June meeting in Vienna.
And considering the U.S. elections, the ability of OPEC to respond, what about the ability of the U.S. to respond? This was supposed to be the period where they're supposed to be refilling the coffers of the SPR. Is this a scenario where they're going to need to wind it down even further as we head into the election? Is that even possible? Is that even advisable for them to do?
Well, they ran down the SPR a huge amount after Russia's invasion of Ukraine in order to keep a lid on prices as they threatened to spiral out of control in the immediate aftermath of the start of the war. I think it'll be harder this time for a couple of reasons. One, they are meant to be refilling, as you say, Danny, that the SPR is a lot lower than it was previously. And I think at this point it would be seen as a very nakedly political ploy to keep prices below, reasonable in the run-up to the election, because gasoline prices are seen as a key pain point for consumers in the US. And I think the Biden administration will be very worried if there's a threat of those prices going well beyond $4 a gallon. $4 a gallon. So I think it's tough.
They certainly don't want that, and they don't want that through driving season for them, the summer season. Will, thank you so much. Will Kennedy there on the oil markets. We've talked about a shift in the bond markets, Danny, and here we are. This is the British bond market and the German bond market playing catch-up. I think there's also a number of other narratives going on here. In the UK, we've got rate cut bets to less than 50 bips this year, and you've got an interview by Megan Green in the FT reminding the market rate cuts could still be a ways off in the UK.
So we've backed off of UK rate cuts. We've also done the same for the ECB here on ECB Day. We've now backed below 75 basis points. Here's my fun fact for you, Manus. Global bonds, their worst day since Feb 2023, the worst day for Treasuries since 2022.
That's it. We give you the facts as well as the...
Thanks, Manus.
No, you're right. But it's a pretty brutal sell-off. It is. Okay, we'll check out the rest of these markets and a few other stories for you in just a moment.
this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep Rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's Bloomberg Brief. I'm Manny Scrani alongside Danny Berger in New York. Now, we knew that it's a tough world out there in consultancy. McKinsey had already put a lot of people on concern notice, but we understand now there's going to be major job cuts. They're starting to cut hundreds of jobs, 3% of the specialty workforce. So you're looking at about 360 headcount to go.
Right, so these are the specialist consultants, as you mentioned. So the more traditional ones, they get to keep their job. But they did have a record $16 billion in revenue last year. But we've seen this warning after warning. Accenture, for example, said that there's less demand for their products. EY, PwC, they've also had to turn away from job cuts. And you also flagged to me, I think I was out when the story came, that they're offering UK staffers some pay to go away.
Yeah, I mean, this was the incentive, which is 9 months' money, potentially, to walk away from the job. But if you look into this story, I mean, the explosion in the size of this company, I mean, this stat is it. They've got 45,000 people in 130 cities around the world. That is up 60% from 2018. So was this explosion in tech, explosion in consulting, all the way around. So this is right-sizing for less demand.
We could add banking to that, too. Also, a huge growth in workforce that they've had to pull back from. Okay, we're going to get back to the data you want to talk about. It's CPI, and then the eyes turn to the ECB. We're live in Frankfurt.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that?
My general advice is continue to seek out companies or people that are maybe
one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the firing line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
With Ludo there talking about they will go in the summertime, but it's going to be cut, pause, cut. That's the risk. What you've got here is Supercore going the wrong way, disinflation going the wrong way. The bond market needs to understand that, and if you get no cuts, does that take you up to 5%? Dollar yen, Kanda has been on the tape trying to push back. There was a magnificent move in the dollar higher against the whole of G10, and yen trading down through a 34-year low. Where is the intervention level? That is the question. Kanda talks about potentially the resistance to this market move, but doesn't use the word bold. And then Brent up 0.4%. We need to understand what is the size and the scope of the Iranian response to the Israel moves last week. We don't quite know what that is, Danny, but this is a very uncomfortable growing narrative in oil prices for the White House and indeed for these bond markets.
And all of that is coming together and when exactly the cuts happen. The political element is so important here, Manus. We were speaking to Ludo about it. He says that if the Fed goes this year, they have to go in June or July because they can't start cutting during an election time. Like they can't be starting a cycle when the voters are going to the polls. So either they do it then or they wait until 2025. But September and November are no-goes because of the political implications.
Let me give you the offer to that trade,
Yes.
which is Alfonso Pecatiello, who was with us. I think you were off last week, but he was with us and he said it will be politically motivated. They will cut. You've had Biden out talking about rate cuts, and Larry Summers talks it would be dangerous and egregious error to cut in June.
Well, now it's the ECB's turn. Now they have to deal with the potential implications of wanting to cut when the Fed is on hold.
And as Ludo said, that leaves them in somewhat of a pickle.
Yes.
Well, let's talk a little bit more about the ECB. They're set to keep the borrowing costs on hold today, record 4% for a fifth meeting, while readying the ground for cuts to begin in June. Joining us now at the ECB in Frankfurt is Lizzie Burden. Lizzie, is that what Lagarde has got to try and do? She's got to try and thread the needle today to keep the June dream alive of a rate cut. Good morning.
Good morning, Manus. Yeah, she's got a more difficult job, of course, after that US CPI print. You have seen a repricing in markets. Currently, traders see less than 75 basis points of easing from the ECB this year. And last week, they saw a fully priced June cut. Now it's about an 80% chance. So as much as the ECB would like to say that it's uninfluenced by the Fed, markets don't believe that. But yes, June, the well-telegraphed starting point. The focus today very much on the path beyond that for ECB rates.
And again, this is what Allianz was talking to us about, Lizzie. He said it to us last time he was on Intuit Us again, that the ECB will be in a difficult position, a pickle as Manus put it, as Ludo said, if the Fed is on hold. So the implications, the potential capital flight, the market risks that come with cutting when the Fed is on standstill, is that still front of mind of the ECB? What could potentially be the impact, Lizzie?
Well, of course, there's the weakness in the euro as a potential risk of jumping the gun, going before the Fed. The flip side of that, though, is if they leave it too long, you could have the euro area tipping into recession. Now, even the most hawkish member of the Governing Council, Robert Holtzmann of Austria, has warned of the perils of leaving rates too high for too long because of this very reason. You haven't had growth in the euro area economy for about 18 months. Compare that to the US, of course, you had that 3% growth over the course of last year. So the risk is recession if you go if you wait too long in Europe.
Lizzie, thank you very much. Bloomberg's Lizzie Burden in Frankfurt. And tune in, the ECB decision, 8:15 a.m. Eastern. We'll be carrying that along with Lagarde's news conference that occurs at 8:45 a.m. Eastern. All right, meanwhile, in the U.S., a hot CPI report, another one signaling a delay for the first rate cut by the Fed. As Manus mentioned, former Treasury Secretary Larry Summers discussed his thoughts on a cut in June or a potential hike.
A rate cut in June, it seems to me, would be a dangerous and egregious error comparable to the errors the Fed was making in the summer of 2021 when it just didn't get the thread on inflation.
Let's get now over to Washington with Bloomberg Global Economy reporter Enda Curran. Enda, the old adage is 3 points make a trend. So here we are, 3 times that CPI comes in above average. Is this no longer a bump and a hill now?
It does feel like the excuses are running a bit thin. One of the standouts yesterday, Danny, from those numbers was just how broad-based the breadth of increases in CPI were. Yes, the usual culprits of transportation and shelter, we kind of know that story, but within the details, you see it across the range of products, you know, that people buy every day of the week. There was a healthcare, car insurance, getting your car fixed, going to the doctor, education. It was all there, all going up, and that's, of course, what's dramatically changed the Fed story. We get PPI today as well. These are the wholesale inflation prices, not expected to offer much solace for the inflation story in the US. Within that, it's about the energy story, but keep an eye also on what's happening with health fees for going to see the doctor. That's going to be part of the PPI story today, along with keeping on airline fares and financial services costs. So between the CPI yesterday and PPI today, at the very least, the takeaway is that the case for a near-term cut by the Fed is certainly not really on the table. That's a consensus, I think, among most economists watching this. The big question then does become, as you were saying earlier in the show, what happens in the second half of the year? Do we reach a point where they can cut? And of course, then the ultimate scenario that Mr. Summers raised would be a rate hike. Not too many people are talking about that just yet, but I think a lot of people are saying that the Fed's narrative on disinflation has certainly come into question.
And listen, we'll see with the PPI. It's amazing how suddenly PPI is an interesting and sort of prescient number for the market. I mean, it has reasserted itself along with the CPI. We've moved on from PC. Let's talk about dollar yen. I mean, what an amazing move yesterday. And the theory was the line in the sand for the Bank of Japan was around 152. We've blown through that. So where is the next maneuver for the Bank of Japan and the Ministry of Finance when it comes to dollar yen?
Yeah, weakest since 1990. I think with Japan, it's less about levels per se and more about the pace and volatility of the move. That's what the officials have always said over the years. And again, they were out overnight making these points that they're watching with a degree of very closely what's happening. Market analysts are making the point that, or interpreting those remarks to say that the government might step in and start buying the yen. They in 2022 to buy up their own currency, and they do so in a way that doesn't trigger any kind of international concern among allies. Remember the era of currency wars not so long ago. They don't want to be seen to be accused of manipulating their currency, and that's why they talk about it's about volatility, it's about the pace of the move rather than outright levels. But regardless of what they do, I think the question is going to become what can they achieve, even if the government of Japan steps in to start buying the currency. What can they achieve given the pace and ferocity of market pricing on the Fed story right now?
Okay, and thank you so much for that. I mean, it is remarkable the global implications of the CPI data from the yen to China, which of course had that inflation stall as well. Bloomberg's end to current. Thank you so much. Manus.
Coming up, we've got a brutal 24 hours under our belt in the bond market as the rates narrative changes. What does it mean for the private credit markets? Well, we'll catch up with Park Square Capital founder Robin Dumas. He joins us on set in New York.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
It's Bloomberg Brief, Danny Berger and Manus Cranny in New York. So it was another hot CPI. You get a mass global bond sell-off, the worst day for global bonds since the banking crisis, with traders adjusting their rate cut bets once again. So it's been a tricky year for the bond market, but what about public credit? But what does this mean for the world of private debt markets, which are in their golden era, as many people have said? Joining us now is Robin Dumar, founder and managing partner at Park Square Capital. Robin, thank you so much for coming. It's really great to have you in the studio.
No, it's great to be with you. Thank you.
So it's a dislocated public market. The rates market has had to do a wholesale rethink of where rates are going. How much of a headwind is that repricing to credit markets?
Actually, I think for private credit, the market environment that we're in today is quite good. And as floating rate lenders in virtually everything that we do, the fact that base rates are going to be a little bit higher for longer is actually quite good for our investors because returns are a bit higher. I think the major story that we're seeing in private credit is the market, which was dislocated 18 months ago, is come roaring back in the syndicated loan market. And that's probably the big news of the day, which is syndicated loans have gone from dislocated to very, very competitive, I would argue white hot today.
Yeah, and we can get more into that, but this idea that higher base rates are good for investors, surely that's not good for the companies who are having to pay that.
It is a bit of a challenge for companies, and so I think it's a very specific type of company that you want to be lending to, companies that have stable and predictable earnings in sectors like software, healthcare, business services, high-margin industrials. But I think you're right to say, for a lot of borrowers, particularly in consumer-facing businesses, particularly in cyclical businesses, this is going to be a difficult time, for sure.
There was this building narrative in the first quarter that rate cuts were coming, the refinancing would be easier, the cliff that a lot of people talked about this year, which was extended into 2025. We're not talking about maybe the door slamming shut on rate cuts from the Fed this year. That is a non-negligible risk. What does that do to the refinancing needs in the U.S. and we'll talk about Europe in a moment, but let's just square it away for the States. Are we entering a little bit of a tenuous time if we go to less and less rate cuts on the refinancing?
Well, rates are an important component of the story, but equally important, if not more important, are spreads. And what we have started to see in the loan market is spreads tightening in very meaningfully. So for a high-quality loan borrower 2 years ago, they may have had to turn away from the syndicated market to the private debt market to borrow. And their spread might have been 6.25 over base rates as opposed to something like 375, which would have been more normal. So a giant premium is what they were paying to private debt investors. And today, banks have roared back with syndicated lending, and so that's a really attractive feature for borrowers today.
To what extent then, I mean, there was this argument that private credit was going to be challenged, you know, that you're eating the bank's lunch. Here we are, and the banks are sort of inverting again. How much are they back in a tour de force? How much more aggressive are they in pricing? How much are they a challenge to your business?
So I would say we benefit actually from transaction activity. So it's great to be the only game in town and for rates to be very high when you're lending. Yeah. The problem with that is obviously people can't borrow. It's just not efficient, and deal activity last year was a 13-year low for levered M&A activity. And so a bit of a healthier financing environment is great for deal flow. And I think, frankly, everybody benefits because we're going to see a significant pickup in deal volume, and that's what we're seeing.
Everyone benefits, Robin? I don't know, but how though? If people were making their lunch money off of the syndicated loan market, off of the market that banks were backing away,
premium, the spread.
Surely someone feels the pain of banks coming in.
So I would say the epicenter of the pain feeling probably is going to be the very large unitranche funds that were taking advantage of the environment to do what would have been a syndicated loan at unitranche pricing. I think that opportunity is probably going away. The big beneficiary, in my view, are the traditional middle market lenders, where that market continues apace, has not been disrupted, and we'll see more deal activity. And actually, junior debt is a massive beneficiary of this, because junior debt coupled with a very inexpensive syndicated loan is going to be the way I think levered companies address a number of the challenges that are out there.
In this world, there's a great debate that private credit and parts of your world need more regulation. We've heard it from various chairmen of banks to various institutions. And I'm just wondering, you know, is there new regulation that can benefit the market? I mean, all regulation is not necessarily, you don't hug it. What is it, death, taxation, and regulation and compliance. But what would you embrace from a regulatory standpoint that can help this market?
I think transparency is good across the board. Transparency is healthy. I think for funds that have long-dated locked-up capital, which most private lenders do, there's no immediate need for transparency, in my view, or as a concern to the system. It's a much healthier way to finance companies than, for example, the banking industry. If you think about a bank, 10 times levered on a good day, and it's got deposits, which is what they use to fund themselves, that can leave overnight. So that's a dangerous combination. If you think about a private debt fund, the money is locked up for 7 or 10 years. It can't leave the system overnight, and the leverage in these funds tends to be very low. So I think it's healthier for the system. Having said that, one of the developments that we've seen is open-ended funds with redeemable capital. And I do think those need to be monitored carefully to make sure that the liquidity that's promised to investors is actually there. So I think that is the theme that regulators are probably most concerned about, which is, have investors been sold a bill of goods, or is the liquidity truly there?
Yes, and that's, you know, to be fair, the IMF also had a warning about this earlier in the week. And they did say, look, the risk wasn't one of wholesale financial stability because of what you say. It's longer-term capital locked up. It's maybe, as you say, some of the more retail-oriented investors. But basically their argument is it has grown so rapidly and it has never experienced a severe downturn at its current size and scope, and many features designed to mitigate risks have not yet been tested. So while private credit maybe has been tested, Robin, their argument is it hasn't been tested at the current size that it's at, and the current feature and the complications that it has. Do you think that's a fair argument?
I think the argument that as you go to retail investors with a complex product and you start seeing fees on fees, I think that is a concern. And so to me, as a regulator, I would be very focused on the retail end of the market. I think for large, sophisticated institutions who are committing in 100 million chunks, they're really smart folks. They can analyze things pretty carefully, and I'm less concerned about that.
Robin, it feels like everyone, though, is trying to get retail money right now. I mean, not just in private credit, private capital as a whole. Is that movement a mistake?
I don't think it's a mistake. It seems to me a natural evolution, this, quote, democratization of alternatives. When I hear that theme, though, my antenna go up. It, you know, reminds me of a sucker's born every minute. And you have to be very careful, I think, just in terms of what are the products that we're offering these investors? What's the overall fee burden? To me, it's the fee burden that I think needs to be drilled into a little bit.
Okay. Robin, thank you so much for being with us this morning, stopping by in New York. Our guest this morning, Robin Dumeur of Park Square Capital. Coming up on the show, highly anticipated, it is ECB Day, and a trilateral meeting at the White House.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Bloomberg Brief. I'm Danny Berger alongside Manish Krani in New York. Let's set you up for your trading day. Here's a look at what's ahead. The ECB will be announcing its rate decision at 8:15 a.m. Eastern, and then we get the press conference by President Christine Lagarde. Then more economic data. U.S. PPI and jobless claims, both of those hit at 8:30 a.m. Eastern. Biden, meanwhile, will be hosting the Philippine president and Japanese prime minister for a trilateral summit at the White House. Manis, how are those stocks looking this morning?
Well, Tesla's on the back foot, Danny, down 0.4%. Musk is actually going to meet Prime Minister Modi, and that's spurring Tesla India investment speculation. So there's an interesting move there. I mean, look, I think a lot of the growth and the Mag 7 generally under pressure, but NVIDIA did very well yesterday. It was up nearly 2%. Stellantis up 0.25%. The CEO there warns of pain if Italy gets a Chinese EV plant. And then Meta debuts a new AI chip, and that aims to decrease reliance on NVIDIA. The stock is down an eighth of 1%. So it is all about that growth to value narrative in a rising rate or an unchanging rate narrative. Danny, the bond market.
Yeah, the bond market has been under some serious pain over the past 24 hours. The worst day for the global aggregate index since February 2023. The worst day for treasuries as a whole since August 2022. And still yields march higher, especially in Europe and the UK this morning.
Yeah, we've also got a cracking story on the Bloomberg terminal. Hop onto it there this morning. Ruth Carson and the team. They're talking about Schroders being short 2s, 5s, and 10s. If you go to a zero rate cutting scenario in the United States of America, does that bring 5% back on the table? Or how quickly do we actually touch 5%, test it, and draw down? Does real money come in? That's the question.
And there are real risks that we don't get cuts so far this year. Again, the political implication, I think, is a fascinating one. Can they really be cutting in September or November if it's an election? They might have to wait till 2025, Manis.
Indeed. Megan Green on the tape in the UK, in the FT, talking about the UK, presumptuous to think that rate cuts are going to come as hard and fast as originally thought. So gilts, bunds, and treasuries all sell off. Day 2 of the rout.
And we get the ECB up next in just a few hours. But first, Surveillance will take it from here.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
What the Fed has done has put upward pressure on Main Street USA.
I think they're trying to say this is a bump in the road. Maybe bump is the new transitory.
Even if it is a bump, no one's talking yet about a re-acceleration in growth or a re-acceleration in inflation.
I do, though, think this is a fundamentally disinflationary economy, and I just worry about an overactive monetary policy, which we've had for many years.
Inflation's not doing what they wanted on average, and this is a problem for them.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. It's the calm after the bond market storm. What a difference one CPI print makes. Allow me to introduce you to a brand new bond market board. If you're away yesterday, things have changed. We've got some different numbers for you. New highs for 2024 on a 2-year, 10-year, 30-year. The 2-year getting closer to 5% at 495.66. The 10-year with a clean break of 450. The quote of the last 24 hours on this program, around this desk, JP Morgan's David Kelly. That's the sound of the door slamming shut on a June rate cut.
And this is the sound of Wall Street completely revising its estimates for when the Fed can cut across the board. Steve Englander at Standard Chartered. We revised our 24 Fed policy rate. RBC, we are changing our Fed call from 75 basis points of cuts to only a 25 basis point move in December. Across the board, yesterday we saw the biggest sell-off, the biggest rise in Treasury yields since 2022, and it seems like there might be more behind it.
Everyone is starting to revise. Lisa, you said this morning before we started, it's the great revision of a day. Seema Shah, similar point to David Kelly. This really seals the fate for the June FOMC to push this further back. You have to think, if we came into this year expecting when will the Fed cut, now it's a matter of some people's mind if the Fed will have a cut in 2024.
It's day two. Let's talk about how this is rippling around the world, not just for the Federal Reserve, but for the ECB and a BOE. Two big headlines crossed on a Bloomberg a little bit earlier this morning. Traders pairing ECB rate cut bets to less than 75 basis points this year. For the BOE, fewer than 50. Look at foreign exchange. The euro, 107.31. The dollar having its biggest one-day move going back to the banking stress of last spring. Dollar yen, we were talking about testing 152. Never mind 152. It's a break of 153, Bramo. 153.16.
The big question behind this is how much does the hot CPI print in the United States really call the hand of the likes of the ECB as well as the Bank of Japan? And how different is the inflation in the United States from elsewhere? In other words, is the U.S. still exceptional? Other places facing off with inflation, but lacking the luxury to cut rates as quickly as they might like because their currency is just weakening so quickly.
Here's the agenda this morning, Lisa. We've got to talk about the ECB at 8:15 Eastern Time. 15 minutes after that, we'll get jobless claims and PPI. Then 15 minutes after that, New York Fed President John Williams. How is he going to respond to the data yesterday and the data this morning?
And that's important because we did hear from two Fed presidents yesterday. We heard from Chicago's Austin Goolsbee, who actually had something very interesting to say, and Richmond Fed President Embark, and both of them didn't seem ready to completely wholesale reset their expectation for a rate cut this year. Austin Goolsbee basically saying, yeah, they're definitely worse when it comes to some of the inflation reads. We're getting to the point where there's going to be more trade-offs than there were last year. Not ready to take a rate cut off the table, but maybe allowing the inflation's going to have to run hotter for them to really kind of cater to some of the pockets of weakness in other parts of the economy.
Yeah, and the other Fed official you mentioned said you have to stay humble with this kind of environment, this kind of data that's coming in. Mohamed El-Arian out with an opinion piece really reiterating and solidifying something he talked about around this table, which is that the Fed, in order to remain progress in the U.S. economy, needs to accept 2 to 3% inflation. And if they don't, they have this potential of ruining the gains that we've made in the U.S. economy.
More Fed speak a little bit later. Equity futures right now on the S&P 500. If you're just joining us, welcome to the program. Equity futures negative by 0.3% on the S&P 500. So much for the grand rotation. Underperforming yesterday, the small caps versus large. Within the equity market on the S&P 500, underperforming the equal weight versus the market cap weight S&P. And outperforming, guess what? In the face of much higher yields, the Mag 7. The Mag 7, NVIDIA positive in yesterday's session. This was pretty brutal for a lot of people.
Remember when this was the rate-sensitive trade, and now it's the rate-insensitive trade, it's the safety trade? People are confused, and that's really what I feel fundamentally. How do you play an inflation story that seems like it's stickier than it was yesterday? At the same time, when you do have some companies that are feeling weakness, and clearly people are saying, I guess just to buy NVIDIA.
Looking for clarity this morning. Coming up this hour, George Concarbis of MUFG following the global bond market sell-off. Stephen Cook of CFR on rising tensions between Israel and Iran. And David Cole of Julius Baer explaining why the ECB may deliver a surprise cut. We begin with our top story. Global bonds selling off as investors slash expectations for a June rate cut. George Concarbis of MUFG saying this: CPI is not PCE, and there are enough differences that this should not completely change the Fed's thinking here. That said, the inflation trajectory and current pace is an issue for the Fed as they want to cut. George is with us now for more. So, George, let's talk about it. The data yesterday, do you believe or not that puts to bed the idea of we're going to get a rate cut anytime soon?
I think it does push it off, and I think that's what we're seeing across all the forecasters, and the market's been doing this all along ever since. And this is really the challenge. I mean, because once you get to a point where the market now is actually underpricing what the Fed has in their thoughts, it does really kind of call into question the timing of, and the timing is critical. The June, July, and if now that's really pushed off, the election, of course, shouldn't play a role if the data gets weaker and warrants an actual cut. But I do think that that they should cut in July. I have that part. I'm not going to change that part of the view. I think that yesterday was an overreaction by the market, but we have a big challenge now here because we were banking on, collectively, the global bond market, on synchronized easing, and now if you have this challenge, we have this unsynchronized easing, and the Fed's delayed. Other central banks are going to be worried as well. So that this does add to volatility, but where it adds to volatility is in the 10-year more so than in the 2-year.
George, lots to unpack there. The word overreaction, I want to get into that just a little bit more. Do you think an upside surprise of 6 basis points? Because ultimately that's all it was. Do you think an upside surprise of 6 basis points was worth a 20 basis point move at the front end of the curve?
That just goes to show you how lack of conviction there is in the marketplace and positioning, and how flows can change very quickly. This is a very binary market. When you're on hold and you're data dependent, both the markets and the Fed, it's going to cause these sort of reactions, in my opinion.
Although Jim Reed did put it well over from Deutsche Bank, talking about how this really calls into the question about whether the bump is really a bump. And we've been talking about this for a long time. At what point does it become a trend and something stickier? And really, from all of the notes, it seems like people are saying this is sticky, and if you discount that, that's going to be at your peril. Why are you discounting that?
Well, because, look, the sticky versus accelerating inflation is a critical point, and it's early in the year. If we're data dependent, we have a long road ahead of us with a lot of things that can change on both, the growth side versus the inflation side. And to kind of only focus on this inflation fear, I think that could call into question. And I think the op-ed from Mohamed El-Arian is a good one. I mean, this might be a world that we're going to be trading between 2 and 3% on inflation, and to jeopardize growth because the Fed's going to wait until they see the actual improvement as well as or weakness in the economy. At that point, it's always too late.
Just to stay on the overreaction concept and just what that says about positioning, we talked a lot about the pretty dramatic moves in the Treasury market. In the currency market, as John was talking about, we saw the biggest one-day rally in the dollar going back to the height of the banking crisis in March 2023. How much are you seeing this as really the difficulty and, frankly, the challenge to some sort of synchronized rate-cutting cycle globally?
It really comes down to the FX markets. I think that's clearly the case. And you know, we look at what's going on with the dollar yen. I mean, this gets into a very potential vicious cycle where that's why the 10-year, the dollar, and oil are super critical. That macro trio is what's really going to dictate what happens going forward. And let's not forget that we've had a very accommodative, or I guess financially easing accommodative environment. If those three variables start moving in a way where it's detrimental to risk assets, then you'll get your tightening there too. So I think all this stuff is in play.
George, let's sit on foreign exchange. The euro 107, dollar yen 153, cable 125. That print yesterday, that move in yields, in rates, stateside, who does that upset more? The Bank of England, the BOJ, or the ECB?
I think the BOJ first, ECB second, BOE third. I think this is really coming down to like this 153, 155 level. It's really important on the dollar yen, and a move in the ECB. I mean, I think we've always looked at the ECB as making policy mistakes. I think they're trying to be proactive. I think they're trying to do the right thing. They probably will have to ease before the Fed, and it's going to be hard. And I think that's obviously a challenge for them. But to just kind of sit here and do nothing is not the right course of action either.
Do you think it tempers their ability to go further beyond flagging a June rate cut at this meeting this morning?
I mean, at a minimum, what could happen, I mean, because like, you don't want to always backpedal, and I think this could then enter into an environment where central banks ease and then they skip meetings and they try to really calibrate the message in between. I think that's really what they can do. Try to really slow down the process and not change the narrative every other inflation report.
This is really difficult, George, because 152, Lisa's been talking about it, was the line in the sand for intervention, and here we are at 153. Steve Englander of Standard Chartered put a note out ahead of this. So this is before the CPI print, and this is what he said. A hot print would mean fighting market fundamentals. That's a difficult intervention proposition. Given where the fundamentals are and how strong the tide is right now against the BOJ, do you think they can intervene in the FX market anymore?
So the challenge, of course, other than just verbal intervention, is that, you know, for the better part of the last 18 months, as the Fed was hiking and then concluding their hiking cycle, and then all these eases were priced in. I mean, in many ways, Bank of Japan was hoping and banking on global central banks easing, and that would take some pressure off the currency. And then now this really does call into question that, and therefore, you know, you start raising rates faster, and then you get into the, you know, the whole yen carry trade and the concerns around that. So I think that, you know, the Japan story is super critical. Obviously, it's important to us, and I think that you know, it does, you know, at a minimum, need to have some sort of intervention. I don't think that a move beyond 155 will be tolerated, and I think that we'll probably see something there, but we don't know, obviously, with clarity on what's going to happen there. But I do think that it's going to now move towards, can the BOJ actually raise rates even more than just 10 basis points at a clip?
Does yesterday's print, George, really challenge this thesis that we've been hearing from a lot of guests, which is go outside of the U.S., that there's more value elsewhere, whether it's risk assets or whether it's currency, that generally it seems like the U.S. is sort of overpriced? Does that get challenged fundamentally based on the fact that the U.S. is still the one printing hot inflation as well as strong growth?
Well, I mean, if you look across your world bond screen on your Bloomberg terminal, as I'm sure you all do, the U.S. is still one of the highest yielding for developed markets. I mean, New Zealand, you know, and a few others maybe, but there's, you know, the attractive yields in the U.S. And that's why I feel like it's going to be hard for fixed income to go unhinged. And, you know, this 450 level is critical psychologically, and we could go to 475 in a 10-year. I wouldn't be surprised. But nonetheless, there's, you know, capital will come to the U.S. because of our higher yields. And I think that's going to benefit more fixed income than equities, considering where valuations are now.
Interesting. George, thank you, sir. George Concavas there of MUFG on the bond market, fixed income, foreign exchange, and global central banks. The 2-year this morning, 4.96. The 10-year, 4.55. I think we have to sit on this, Bramo, just a bit longer. There is a reason, many, why people have been so constructive risk assets this year. One of them was this belief the Fed put was back, that the Federal Reserve had the space if they needed to respond to adverse shocks because disinflationary trends would allow them to do so, that the emphasis was going to shift towards potential weakness and away from being worried about strength. I just wonder how much that inflation print and the last 3 prints changes that story.
It seems like the market is saying quite a bit. This morning, at least if you look at the pricing and you look at a lot of the notes, signals the beginning of a narrative shift. I don't know if it's an actual shift economically, but a pretty massive narrative shift where the bumps in the road are something that's much more intractable, and people are not just questioning when the Fed's going to cut rates, but they're actually increasing the rate that they think they're going to be able to stop at. This is a longer-term kind of inflationary story that people are starting to grapple with.
Bumps in the road or new terrain, and I think after yesterday, I think a lot of people leaning towards maybe new terrain. Let's give you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Justice Department has opened an extended antitrust investigation into Nippon Steel's takeover bid for U.S. Steel. It means the $14 billion deal will likely be delayed. Both companies had hoped that they'd see approval in the second or third quarter of this year. This, of course, has become a very hot button issue ahead of the election. President Biden, for his part, said that he wants U.S. Steel to remain domestically owned, but did stop short of making an explicit push to kill the deal. Donald Trump says he would try to block the takeover. Lufthansa has secured a new wage agreement with its cabin crew after months of intense negotiations and strikes. This deal will give Lufthansa's 19,000 cabin employees a 16.5% wage increase over 36 months. They'll also get a $3,200 inflation compensation bonus, as well as other concessions. The agreement will be valid and protect Lufthansa from strikes until the end of 2026. New York City and Miami's return to office rates are almost at 80%, and it's also the highest, those two, among major U.S. markets, according to one measure. The data comes from Placer AI, and it shows that Wall Street is driving the rebound in Manhattan, with big banks aggressively encouraging employees to return to office. And really, you can thank J.P. Morgan and Goldman Sachs. Those two in particular have been helping to drive the numbers up. That's your Bloomberg Brief. John.
Danny, thank you. I'm sure local politicians are lining up to thank them. Well, maybe not.
All I can say, aggressively encouraged. What does that look like? I encourage you to come back to office, and if you don't, we will aggressively empty out your desk.
Yeah, that or adjust your bonus.
Yeah, exactly.
I think we've all got the message, haven't we?
I think that that's the case, and I think that there are a lot of mixed feelings about it, but this is the new norm.
This is. Equities right now negative 0.3% on the S&P. Up next on the program, growing tensions between Israel and Iran.
Our commitment to Israel's security against these threats from Iran and its proxies is ironclad. Let me say it again, ironclad. We're going to do all we can to protect Israel's security.
That conversation up next, live from New York City this morning. Good morning.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert. expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
earnings season is coming.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead is coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting. Bang in line with estimates.
We will have full and instant analysis.
It all starts Friday on Bloomberg. Context changes everything.
Yesterday was an absolute sea of red. You're not getting a repeat of that, but the board's the same colour. We're negative 1/3% on the S&P 500. The dollar's stronger again against the euro, 107.27. Crude was rallying for a heartbeat. We're lower again. We're down about 0.5%. WTI, 85.73. Under surveillance this morning, growing tensions between Israel and Iran.
We also want to address the Iranian threat to launch a significant. They're threatening to launch a significant attack on Israel. As I told Prime Minister Netanyahu, our commitment to Israel's security against these threats from Iran and its proxies is ironclad. Let me say it again, ironclad. We're going to do all we can to protect Israel's security.
Here's the latest this morning. The US and its allies warning Israel of a looming attack by Iran or its proxies. The potential assault could happen in the coming days, according to people familiar with the intelligence. Stephen Cook of the Council on Foreign Relations writing this. Washington has been messaging to Iran about the consequences of escalation, but I don't think Biden or the administration's officials believe they can warn off the Iranians. The Israeli strike in Damascus was too bold, too effective. The Iranians would look extraordinarily weak if they did not respond. Stephen, I'm pleased to say, is with us now for more. Now, Stephen, we've been talking about this word imminent now for the best part of 2 weeks. Can we focus more on what the nature of retaliation, the character of it, what it would look like? What do you think it would look like?
Sure, there is a lot of speculation that the Iranians would directly attack Israel. I think that that's probably unlikely given the capabilities the Israelis have and the warnings the Israelis themselves have made that it would respond in kind directly on Iranian territory. Though I think that Israeli diplomatic installations around the world are definitely in the line of fire. In a sense, and not to torture something that people say all the time about the Middle East, but it is an eye for an eye. The Israelis attacked the IRGC commanders, Islamic Revolutionary Guard commanders, at a diplomatic installation in Damascus. It would be in keeping with the Iranians to choose their place and time to respond, but in kind against Israel's own diplomatic installations.
Stephen, if they're going to attack, say, an Israeli embassy or consulate or an official in a foreign country, what countries would be almost acceptable to Iran in order to not start a fight with that foreign country?
Well, I'm certain they won't choose the United States as their place for retaliation. But in Europe is a likely target. South America, not unprecedented. If you go back to the 1980s, Iranian agents attacked a Jewish community center and Israeli diplomatic installation in Buenos Aires. So in Asia is another place where Iran has significant capabilities and networks through its so-called axis of resistance. So those are the areas. Those wouldn't necessarily be acceptable to the host governments, but of course, taking the step of trying to attack Israelis in the United States or certain Western European countries would be perhaps a step too far for the Iranians.
Stephen, I'm hoping you can help me understand what happened in the past 12 hours when the Iranians came out and said that they were closing air traffic over Tehran, and then their news agency removed the report about closing that airspace. Was this supposed to signal that they were potentially going to have an almost immediate strike?
I do think that there's a fair amount of psychological warfare that's underway over this. This is the second time in the last 7 or 8 days in which we have been warned of an imminent attack that has not come. So indeed, I think the Iranians are trying to keep everybody on their toes and surprise them. And so I would put that in the category of a certain amount of psychological warfare underway between the two countries.
Stephen, you're speaking from Delphi, Greece, and you're at the Delphi Economic Forum, where you're going to be speaking, and you have been speaking with a lot of different leaders, not only of countries, Volodymyr Zelensky is there, but just leaders economically around the world. I'm sure they're all asking you, so how bad is this? Is this going to percolate out? What kind of chance of escalation do you see? What are you telling them when they try to game out and understand what we're working with, what we're looking at?
Yeah, I think there are two questions that people are asking. One is, will the conflict widen? And my answer to that is the conflict has already widened. If you take a look at what's happened in the Red Sea, in Syria, what's happening in Lebanon as well, then they want to know about a direct United States. I think there's a lower probability of Iran in the United States than Israel in the United States. But I think that particularly if the Iranians choose to attack against Israel directly, I think the escalation spiral is quite significant.
Do you think it's being priced in or genuinely appreciated by some of these investors and people who have kind of pushed it to the side for now?
Yeah, I think that there is, you would know better than I would about whether they priced it in, but there is grave concern about the conflict in the Middle East intensifying and becoming beyond this kind of a Red Sea theater, a Lebanese theater, an Iraq-Syria theater to a Middle Eastern theater. And that is really top of mind for people here in Delphi and I imagine elsewhere.
Stephen, can we just finish on Iran? I think Iran is very misunderstood and has been for a long, long time. They're very calculating. Everything is very precise. Stephen, can you talk to me about how misunderstood Iran in Iranian policy might be? And that question is in no way an endorsement of Iranian policy. Let me be clear about that. I just think they're increasingly misunderstood. What are your thoughts on that?
Well, no, I think that that's right. And I think it's particularly misunderstood in Washington. For the better part of a decade, policymakers and analysts in Washington have believed that there could be a different kind of relationship with the Iranians, a more constructive one, when I think it's clear, recent events have made it abundantly clear that the Iranians do not necessarily seek a better relationship with the United States. They actually prefer to push the United States out of the Middle East. When it comes to this question of a response, I think you're quite right. The Iranians are more calculating, will take their time to determine where and when would be most effective to respond to Israel's strike on the Islamic Revolutionary Guard Corps' commanders in Damascus.
Stephen, thanks for making time for us this morning. Appreciate it. Stephen Cook of the Council on Foreign Relations in Delphi, Greece this morning. Crude was positive. Anne-Marie is now negative by 0.5%. Just about holding on to 90 on Brent. WTI 85.74.
Yeah, and you just have to watch what the heightened geopolitical risk potentially could mean. To Stephen Cook's point, they will take their time. The Iranians have a very almost legal way of going about this process. They encompass everyone at their National Security Council before they decide where to go, how to respond, and what the implications will that mean. I'm looking for when the U.S. Department comes out and says, do not travel to this country, when Israeli airspace closes, when airlines say, I'm not going to fly over this airspace. I think that is when you know that potentially something imminent is on the way.
I can tell you the last thing this market needs right now after yesterday is another big rally in crude. That's for sure. Just a little bit softer on the morning. Coming up next on the program, Virginie Masseneuve of Allianz Global Investors as equities on the S&P 500 attempt and fail to recover from yesterday. Equity futures just a little bit softer. From New York, this is Bloomberg.